Yeah, good evening, participants. I welcome you all to this second day of a refresher sort of thing on valuation, important topics on valuation. We have with us, we are joined by RCM, Madam A.B. Geeta, CA A.B. Geeta, and also our RCM and ex-officio of Vijayawada branch, CA T. Chinnamassan. And also we are joined by Secretary of Vijayawada branch, CA Srita Shirin, and also one of the faculty for today's session, CA Hemant Kumar sir also. Now may I request the Secretary of Vijayawada branch, CA Srita Shirin madam, to introduce Madam CA A.B. Geeta to the participants, please.
I'm most privileged to introduce CA Geeta ma'am. CA Geeta AB was first lady from Karnataka to contest for SARC's elections 2019-22. She won the elections with the highest mandate and is presently serving as president of SARC of ICAI. She is practicing chartered accountant with 15 years of professional experience and specializes in the field of direct taxation and auditing. She is a partner of Geeta Chandrakant and Company, and she was the first lady chairperson of Bangalore branch of SARC of ICAI in the year 2017-18, which was set up in 1962, catering to the needs of nearly 14,500 CAs and around 40,000 CA students. She served in various capacities in Bangalore branch, all being the first lady treasurer, first lady secretary, vice chairman and vice chairperson and chairperson. She was the executive committee member and first lady treasurer of KSCAA, and her contributions to the CF professional fraternity pertaining to Bangalore branch is commendable. And she held so many positions as chairperson and member of so many committees of SARC of ICAI. And she took the initiative of conducting first CA Women's Conference in Bangalore, which was well appreciated by members, and thereafter it is being conducted regularly every year. She introduced a student speakers forum, wherein students have been trained in communication and public speaking skills, and around 1,000 students have been benefited out of this program. Her twin daughters qualified CA in the recently held exams in the first attempt. It is a rare achievement among the CA fraternity. Thank you, ma'am. With this brief introduction, I request CA Geeta ma'am to present upon the topic. Thank you.
Thank you, Shirin, for your kind words of introduction. I thank Vijayawada branch, headed by Chairman G. Srinivas Rao Garu, and Suresh sir, Shirin, and Central Council Member Prasanna sir, and ex-officio Chinnamassan, and all other senior members for giving me this opportunity to be one of the panelists in this unique program. So yesterday, friends, yesterday you would have enlightened about Code of Conduct Rules Companies Act by GKR sir and Dhanpal sir. So today, the area which we are going to cover in the valuation is a core area of valuation. And you're all aware that the valuation exam is for 100 marks. Out of 100 marks, 62 marks is for valuation. And out of 62 marks, in today's session, we are going to cover 3 marks. That is for valuation approaches and methods. Though it is for 3 marks, this is the fundamental basis for all other valuation related topics and problems. Let it be from overview of valuation till the case studies and judicial laws. The base for valuation is first we need to understand the conceptual clarity of valuation approaches and methods. First, I would like to explain you what my presentation strategy. So I divided my entire 60 minutes presentation into 3 parts. 5 minutes will be for introduction, because this is the first day of this core valuation of introduction we are touching about. So what is the valuation, what is value, and what is price, and what is the basis of the prices and all value. And the second part, the second 30 minutes, I would be covering the approaches, 10 minutes each approach, the 3 approaches: cost approach, market approach, and income approach. And the third one, the later part, would be covering on MCQs, so that it will be revisiting whatever we have learned today, and it will be need of our how to approach the MCQs in the examination. So let us start our today's session with the introduction of the value. Okay. First, let us see what is the meaning of value. The valuation is nothing but the process of determining the worth of financial statements. The worth of financial statement, whatever we are arriving, that will be the intrinsic value. So this intrinsic value would be compared with the market value, and it will be useful for making the decision whether to sell or buy the securities, the assets. So if the market value is more, obviously the asset will be overstated, and we don't buy, and we will prefer to sell the asset or security. If the market value will be less than the intrinsic value, whatever we arrived at by calculating the worth of the financial asset, then it would be preferable to buy the asset. Now let us go to the next one, the types and bases. So the bases for value are many. The value is different in different cases. The standards of value may depend upon so many types. This is a fair market value, fair value, intrinsic value, and the sum of parts. But it depends upon the context and purpose on which the valuation exercise is being carried out. Let us go to the next one, the premise. So the premise has been defined under 201 of the valuation standards as the conditions and circumstances of how an asset is deployed. So the premise is broadly classified into two categories. The one is the going concern premise approach, and the second one is liquidation. And again, under liquidation, there are two broad categories. The one is liquidation under orderly liquidation and the forced liquidation. Then comes to purpose. The purpose is the value arrived for valuing for exercising the value of a particular asset. The purpose might be to sell the business or to determine the share value for adding new shareholders, or to attracting the potential investors for our equity or debt financing. Then it comes to process. The process starts when we understand the business, planning, preparation, and analyzing and selecting the appropriate valuation models, and to arrive the valuation by using the professional judgment. So this is the syllabus which we are going to today, and this is as per our syllabus which is mentioned in our valuation course. So it is broadly covered for three approaches. Yeah, income approach, market approach, and cost approach. And the valuation approaches, the income approach. The first we'll discuss about the income approach. Under income approach, the majorly used method under income approach is the DCF method, that is the discounted cash flow method. And the rest of the methods, okay. DCF method, and if you see in the market approach, there are two methods. The one is comparable company approach method and the comparable transaction method, which we will discuss in the next slides. And the third one is the cost approach. Under cost approach, so it is a net asset value, book value, and the replacement method and reproduction cost method. And the third one is the summation method. So under IVS 105, the cost approach and cost approach, three methods has been broadly classified. So summation method is also there, but if you compare, if you see the Indian valuation standards, only two methods has been prescribed. So first we'll start with the income approach. So income approach is the value of an asset is determined by reference to the cash flow or cost savings generated by the asset. Income approach is a valuation that converts the future benefits, the future cash values into the present value. Under income approach, if you see, it is on future economic benefits, and it is the in valuation approach that converts maintainable future cash flows in the present value of the money. And under the income approach, the DCF method is the main method. Under DCF method, we need three inputs, that is cash flow, discount rate, and terminal value. So other than this DCF method, we have other methods also, that is the relief from royalty method, multi-period excess earnings method, with and without method, and the option pricing. So this DCF method, usually for estimating the DCF method, we consider the life of the asset and cash flow and discount rate and terminal value. And for evaluating this relief from royalty method, we calculate the estimated estimates based upon the present value of the royalty payments, future royalty payments saved by owning the asset instead of owning the asset. So instead of taking as a instead of owning the asset, if you avoid the expenditure for paying the royalties. And the next one is the multi-period excess earning method. So the multi-period excess earning method is the incremental value of the lead asset or the significant intangible asset. So we have to calculate the incremental future cash flows of the lead asset, and then we will calculate with the PV of the calculations, and we'll deduct the contributory asset charges from the valuations, whatever we derived it. And usually we do prefer to take the after tax cash flows. And if you say the with and without method, so the with and without method is the value of the intangible asset calculation, and it is used for valuing the asset, including the intangible asset, and as two scenarios. First, including the intangible asset, and valuing the intangible, valuing the asset without intangible asset. So we'll find out the difference, and later calculate by the present value of the future cash flows. So if you see the next method, the DCF method. So under DCF method, as we discussed earlier, we need three inputs. It's a cash flow. So either we can use cash flow or either we can use cash flows or interest in case of bonds, or dividends in case of shares. So we can use these three types of future cash flows for calculating this DCF. And under cash flows also, we have two categories, two methods. The first one is free cash flow for firm and free cash flow available for the equity shareholders. So for calculating the free cash flow for firm, we use the discount method, discount rate to discount the free cash flows. So if you use the free cash flow for firm, we use the WACC method. What is WACC? The free cash flow for the firm consists the capital structure of the equity shareholders, preference shareholders, and the lenders. So we have to calculate the cost of equity for calculating the equity shareholders cost, and the KD, that is for this is the cost of debentures, and the KP, that is the cost of preference shareholders. And we take the weighted average of the three costs, and we apply that discount rate with the future earnings of this free cash flow for firm. And the next one is the free cash flow for equity. So for calculating the free cash flow of equity, we use only the cost of equity to discount method. And we already discussed about the discount rates, the cost of equity we have covered, and WACC. And the next one is CAPM. The CAPM is the method which is used to derive the cost of equity by using the RF, that is risk-free return, plus beta beta to the this one market rate of return, premium, expected market premium, risk-free market premium. And the next one is the terminal value. So the terminal value is basically the present value at the end of the life of the asset. To calculate the terminal value, we can use the Gordon constant growth model or variable growth model or exit model. Through three models we can use, but majorly used model is the Gordon growth model. So this under this Gordon growth model, if the growth rate is constant, where the cash flows are divided by discounting rate after reducing the growth rate. So if the growth rate varies, then we can use the variable growth rate. The next method is the exit multiples. So exit multiples, we can use the exit multiples method. Involves application of market evidence based on capitalization factor or a market multiple. Let us see the income approach, when we can use the income approach and when not to use, or we can use the income approach in combination of with the other approaches. When to use the income approach, where the asset does not have the market comparables, and where the asset has fewer relevant market comparables, or the asset is an income producing asset. It is best suitable for asset capable of generating future cash flows or asset having no other comparables. So when not to use, or when it can be used in combination of the other approaches. So for the asset which has not yet started generating cash flows, obviously we will not be having the cash flows. Then in such a case, we cannot depend mainly on the income approach, like WIP projects or the assets where future cash flow is uncertain, that is the newly started projects. So in such cases, we cannot use only the income approach. Then comes to market approach. The next approach is the market approach. The market approach is mainly used when the assets are comparable. Let me make it simple. It is used for classes of plant and equipment that are homogeneous. So the market approach is commonly used as there may be sufficient data of recent sales of similar assets. So if we see the methods under market approach, there are broadly categorized into two methods. The first one is the guideline transaction method. The guideline transaction method is used when calculating the past mergers and acquisitions. So how much the acquiring company paid for that business. So this term of valuation includes the takeover premium. Generally, more money is paid to take over the control position. So taken together, these two forms of market approach will provide the overview of the company, might be worth compared to the other companies. So if you see the guideline public traded comparable method, under this method, the comparables will be for the whole company, not for a transaction based, it will be for the whole company together. So for example, this subjected company is sufficiently similar to the public traded company comparable to allow the meaningful comparison. So this is relatively easy to find because these companies, company shares were listed on the stock exchange regularly, and we can find the price at any time and whatever other investors are willing to pay for that company also we can determine. And other methods under this guideline transaction method is the EBITDA multiple, revenue multiple, and earning multiple. So we have to calculate the multiples of multiples of the comparable company. So first we will see how to calculate these values. So first we have to identify the comparable company comparable company, then calculate the appropriate multiple, either it be the EBITDA multiple or revenue multiple or earning multiple. Then we have to make the adjustments whichever is required depending upon the size, location, and other relevant parameters which need to consider, and then applying that multiple to the parameter of the relevant parameter of the subjected company. And while doing these adjustments, while arriving this value, we need to consider the three adjustments. That is the discount for lack of marketability, discount for lack of control, and blockage discount. Take this as an instance. Mr. A owns 20% of a business and the balance 80% is owned by other people. So here, if A is what he is holding is minority interest, it is 20% interest. Let us assume the business is worth 200 million. The 20% interest in the business would be worth less than 40 million. So in the open market, if he, the willing and able buyer pay perhaps 50% of the total value of 20% interest because they are subject to control of 80% owners. That means there will be a discount known as DLOC. When it comes to this one, discount for lack of marketability, public traded securities can be bought and sold nearly instantaneously, but the private limited companies, unlisted private listed companies, takes longer period to sell or buy the securities. So here the lack of marketability discount has to be considered while valuing in such cases. The next comes to blockage discount. Okay. The next comes to blockage discount. So blockage discount is a discount that is applicable when the asset represents a large block of shares in a publicly traded security such that an owner would not be able to quickly sell the block of the asset. So he sells that asset with some discounted value. So this we will consider as the blockage discount. Let us see the example. This is the examples of the market multiples. So the sales here is 2050 and EBITDA 650 and PAT is 420. And the EV multiples of the company, the comparable company, is the sales multiples is 3 and EBITDA multiple 9 and PAT multiple is 8. The sales multiple, so now we are, this is the first one, the sales and all is the subject to company sales, and the EV multiples, which are the multiples of the comparable companies. So now if we multiply the multiples with our subjective company, then our sales multiples become 6,150 and EBITDA multiples 5,850 and the PAT multiples becomes 3,360. if we have to calculate the DLOM of at 20% on sales multiple, that is on 6,150, we had to calculate 20% of the lack of discount for marketability. So this discount lack of marketability may be calculated either on the basis of the value or on the basis of some percentage. Let us see the advantages and disadvantages of this market approach. So the advantages are, it is easy to use and understood, and we are all considering the market, and we consider the market information, and we know the mood of the market is also reflected. And the second one is the consistency. And the third one, it reflects the kind of the mood. And the third, that when it comes to disadvantages, it suffers from volatility, and finding perfect match is really a challenging task, and differences in accounting policies, so with that we cannot find the perfect match of the comparables for our company valuation. Okay. Yeah. And now the third approach. Now we came to the third approach. This is the cost approach. The cost approach provides an indication of value using economic principle that a buyer will pay no more for the asset than the cost to obtain the asset of equity, equal utility. So, for example, if you wanted to value a company that has manufacturing facility, how much cost involved to build that facility and what was the cost involved in it? So this cost approach has been categorized into three methods. The first one is the replacement cost method, and second one is reproduction, and the summation method. Under replacement cost method, we have to calculate the cost incurred, cost to be incurred to recreate the similar asset which may be having the similar qualities. But under reproduction cost method, the cost that indicates the value by calculating the cost to recreate a replica of an asset. So please find the difference in replacement and reproduction. In replacement, we use the cost of a similar asset. But in reproduction, we use the cost of recreating the replica of the asset. This is the main difference between the replacement and reproduction. Otherwise, the calculation part and everything would be same for the for both the methods. So, how to calculate this cost? Okay, first let us come to the summation method. So, summation method is a method where we use for calculating the different divisions, especially in the case of holding companies or the company having different divisions. So we have to value the division wise on a standalone basis and summing up the all different unit value in one value. So let us see the replacement cost method. So replacement cost method, as I said, it is the replicating the utility of the exact of the exact physical properties of the asset. It is generally that a modern equivalent asset. The similar function and equivalent utility of to the asset being valued. So we must do adjustment for physical deterioration and all relevant forms of obsolescence. And friends, you observe this physical obsolescence is a much broader concept than the depreciation. The physical obsolences are broadly categorized into three types. The first one is physical obsolescence, functional obsolescence, and economical obsolescence. The physical obsolescence is a loss in value on account of decreased usefulness of the asset of the useful life of the asset. Then the functional obsolescence represents the loss in value on account of new technology developments. And the third one is the economic obsolescence. It represents the loss in the value of the account on account of the change in environment or the external factors. So the loss occurs due to the change in external economic factors or excess supply or high interest rates. So this is an example for replacement cost. The cost of the building of, say the cost of the building, replacement cost of the building is 20 meters into 10 meters, and the construction cost is 15K per square feet, and the building is 7 years old, and life of the building is 60 years. So if you calculate the replacement cost, so 20 meters into 10 meters into 15K, that it comes around 3,000K. And you have to less depreciation or the obsolete cost, whatever is there. And if you calculate the depreciation, the 3,000 divided by 60, that is the life of the building into the building value. So it comes around 350K. So the 350K, if we deduct the depreciation from the replacement cost, the expected cost of replacing the asset, then we will arrive the replacement cost. So this is the key steps. And the first, you have to calculate all the costs that would be incurred for creating that asset, and you have to identify the depreciation and calculate the depreciation, then deduct this depreciation from the value, the calculation, the cost we arrived at. The next method is reproduction cost. Reproduction cost is appropriate in the circumstances where the cost of a modern equipment asset is more than the cost of creating a replica, and the utility of the subject asset can only be provided by the replica rather than a modern equivalent asset. So the value, the key steps which is followed in the reproduction cost will be same as the replacement cost method. Calculating the cost first and later deducting the depreciation or obsolescence value, then arriving the reproduction cost. The last one is submission method. As I said, the submission method is useful for multi-divisional companies, holding companies, or the conglomerates. So identify standalone basis calculation and later adding all the values. So this is the two steps: identify the value of each of the component asset and then add the value of the component asset together to reach the value of the asset. Let us see when to use the cost approach and when not to use, or use in combination of the others. So where asset can be quickly created, where past performance of the company doesn't matter, loss-making company or liquidating company, the cost approach is best suited method. It is, however, not preferred for valuation of intangibles. If you see the asset, the approach, this is a cost approach, when not to be used or used in combination of other approaches, when there is high, in case of the asset is not started generating the income, and the asset of substantially the same utility as the asset to be valued can be created. So now let us see the multiple approaches, when to use the multiple approaches or when to use a single approach. So when to use only one method. Valuers are not required to use more than one method for valuation of an asset, particularly when the valuer has high degree of confidence in the accuracy and reliability of the single method given the facts and circumstances of the valuation engagement. So if you use the multiple approach, when we use a multiple approach, when we have the insufficient factual inputs within the single approach, then we can use the multiple approach. But it's the valuer's responsibility to choose the appropriate approach. But when if the value differs while calculating these multiple approaches, then the differing values has to be disclosed in the report itself. if the different approach, if you use different approaches and the difference or widely divergent indications, it gives the divergent indications, then it's a valuer's responsibility. He should perform procedures to understand why the value indications differs. So now let us come to the MCQ part. Before starting the MCQs, what is the time? Before started the MCQs, yeah. Okay. As I discussed in the starting of my session, that each question carries 1 mark with 0.25 negative marks for wrong answer. So even quarter a mark is also very precious. Friends, I have seen a few of my friends, they couldn't qualify, they couldn't pass the exam, even though getting for 59.75 marks. So the quarter mark is very important. We need to be extra cautious while answering the questions. It is not necessary that we have to attempt 100%. If you attempt 70 questions also, we may succeed. There's a chance of succeeding the exam. So we have to follow one strategy. As I was mentioning about this in yesterday's session, we have to divide in 2 categories: the preparation before exam and the strategy to be followed during the exam. So for preparing before the exam, first we need to book the slots, because getting the slots is challenging nowadays. If possible, book a couple of slots and then take the printout of your syllabus, and you select the reference books which you are willing to refer, and then start your studies. If possible, do the group discussion, group studies. We did group studies, so it will be useful while discussing these MCQs. And as you know that the exam is for 100 marks, and out of 100 marks, 80 marks questions, 80 questions will be for 80 marks, and the 10 questions will be for 20 marks. That is for case studies. 3 case studies will be there. 4 questions with 2 marks, and 2 questions with 3. That is 6 into 2, 12 marks. So all put together 20 marks. But don't worry if you because few people see to follow the strategy of dividing the questions, which I am confident, I am not confident, 50% confident, 70% confident and all, because a few people they feel it's difficult when they are engrossed in the exam. So it would be difficult to make a note of all those kind of things in the paper. So better to start the exam as it comes, and you would answer the exam, the questions as it comes. But only thing is required is you have to be with the calm and relaxed mind. So once you start the exam, you just answer the question as it comes. First view the summary and you find out the case laws and what whether you are comfortable with that, and whether it is worth to spend more time for the case studies, or else you can concentrate the time available for the 1 mark questions. So with that background, just we will go to this MCQs. We will try to solve it, and if possible, if anyone is if anyone is willing to answer, you can answer these MCQs. We'll try to test whatever we learned today, whether we can answer these questions. The first one is which of the following methods is included in asset-based approach? That is cost based. For A, comparable companies multiple method and replacement method, earning capitalization method, or discounted cash flow method. Can I see the chat box? No. Yes. Yes, yes. Yeah. Correct. Replacement cost method. No, I cannot see this. Replacement, because if you because comparable companies method is not possible, and so capitalization and discount cash flow methods or all falls under income approach. So the only approach falls under cost method is the replacement method. The second one. The second one is an analyst is valuing a firm's equity using sorry, my battery got down. An analyst is valuing a firm's equity using enterprise value to revenue ratio of similar firms. Which of the following is not a factor that the analyst should use? So the option A is revenue growth, EBITDA margin, expected return, and net present value. Can I expect the answer? Yeah. I couldn't see the chat box.
Ma'am, press the chart, ma'am, so that you can see the chart. Chart will be open to you.
It's ekkada undi?
Majjalo undi, madam. Beside polls and share screen. Chart.
Okay.
Press the chart button.
Yes. Okay. I found it. Okay. Which one is the answer for the third question? Nidhi. Suresh Kumar. Yes, it's a net present value. Net present value. Because separate. So 1 second, sir. Yeah, I cannot do that. Okay. The next question is, which one of the following is covered in the valuation report? Proposed transaction, related parties, shareholding pattern, and valuation methodologies. Sir, వాళ్ళని అన్మ్యూట్ చేస్తారా? ఎవరైనా నాకు చాట్ బాక్స్ నాకు ఇదిగా రావట్లేదు.
I could not get you, ma'am. Em madam?
లేదు, నాకు చాట్ బాక్స్ అది నాకు ఓపెన్ చేస్తే నా క్వశ్చన్స్ కవర్ అయిపోతుంది. నాకు క్వశ్చన్స్ కనిపించట్లేదు.
ఓకే. అంటే మీరు ఎగ్జిట్ ఫుల్ స్క్రీన్ అని ఒకటి పెట్టుకోండి మేడం. వ్యూ ఆప్షన్స్ లో ఎగ్జిట్ ఫుల్ స్క్రీన్ అని పెడితే మీకు అడుగున ప్యానల్ కూడా కనిపిస్తుంది. అంటే మీకు పీపీటీను ఇది సైమల్టేనియస్ గా కనపట్లేదంటారా?
అవును, అంటే నేను చాట్ బాక్స్ ఓపెన్ చేస్తే నావి ఇదైపోతుంది, అడ్డమైపోతుంది.
ఓహో, అదే.
సరే, పర్వాలేదు సార్. నేను యాక్చువల్లీ
పంచేయండి మేడం. పక్కన మీ రైట్ హ్యాండ్ సైడ్ టాప్ సైడ్ లో వ్యూ అని ఉంటుందండి. అక్కడ సైడ్ బై సైడ్ స్పీకర్ అని ఉంటుంది. ఆ మోడ్ పెట్టుకోండి.
Well, madam, I can help you.
Yeah, please.
Yeah, I'll help you. The question number 4 from the feedback is D. Answer D is the feedback from the members, madam.
Not that, sir. Just she's asking.
If she could not able to see the chat box, I'll help her to see the chat box message so that it will proceed further on that.
Okay.
Madam, మీరు what you can do is ఈ chat పైన left to.
Madam, very quickly, madam. Another 10 minutes is that quickly you can proceed. D. Answer D. Proceed next.
Yeah, answer. Okay. సార్, మీరు అక్కడ ఉంటే ఆన్సర్స్ చెప్పాలి. మీ ఆన్సర్
నేను చెప్తాను, మీరు పాయింట్ స్టార్ట్ చేయండి.
లేదు, మీ ఆన్సర్ చెప్పకూడదు. బీయింగ్ ఏ స్పీకర్,
మెంబర్స్ ఓన్లీ. కేశవ శ్రీనివాసులు ఆన్సర్ వాల్యుయేషన్ మెథడాలజీ.
ఓకే.
Go ahead, next
one.
Start from current slide. Yeah.
Okay. So an analyst is valuing a firm's equity using enterprise value to revenue ratio of similar firms. Which of the following is not a factor that the analyst should use? Friends, you would be surprised. The same question was already repeated. It happens because in exam also the same question gets repeats with the different options. So we should be very extra cautious. We should take extra care while answering the same question. See here, the options given is revenue growth, EBITDA margin, expected return, and debt equity ratio. But in the earlier question, the fourth one was the net present value. So obviously, the answer for this is the only that option they have changed. The answer is debt equity ratio. And the next one, okay, the income approach can be expressed as the following formula. Sir, Hemant, sir, answer.
Yeah, madam. Still, people are not prepared.
Okay. The present value is equal to
B. Mr. Gauri, yes. Gauravi, yes. Answer B.
B now.
B, D.
No, D is the correct answer because
D.
the present value is calculated.
Yeah, Jayashree Srinivasan is Sriraman is D.
Yeah, D is the correct answer.
Yeah.
Future value, always we calculate the present value by calculating the future value divided by 1 plus I to the power of n.
Correct.
And the next question, more than one valuation approach or methods may be used to arrive at an indication of value, particularly. So under these situations, whichever is the situation, which is the situation, there are sufficient factual or observable inputs for a single method to produce a reliable conclusion. There are insufficient factual or observable inputs for a various method to produce a reliable conclusion, or there are insufficient factual observable inputs for a single method to produce a reliable conclusion. Don't jump into the conclusion first if you see the insufficient factual or observable, because with the same wordings, one more option is also available. So we have to choose between.
Hello, Shirin garu.
7C, somebody is giving 7C.
Yes, C is the correct answer.
Okay, next.
Yeah, and the next one, in which method the value of the asset is estimated based on the present value of the royalty payments saved by owning the asset instead of taking on lease. So once, comparable companies multiple method, transaction multiple method, relief from royalty, replacement cost method.
8C, somebody is giving 8C.
Yes, exactly. Because once you see the royalty payment, it relates to the royalty, relief from royalty under intangible asset valuation. And the second one, next one, a fundamental basis for income approach is present value of future cash flow, discounted cash flow, discounted free cash flow. Investors expect to receive a return on their investments.
Somebody says A, somebody D, A.
Yeah, friends, here we need to understand the question first. That's what we should most familiar with the question. The fundamental basis, they didn't ask how to calculate or the method to calculate. The fundamental basis for income approach is investors expect to receive a return on their investment. The D is the correct answer. Next one is, which is the most commonly used methods for calculating a terminal value in case of indefinite lived assets? So A is market approach, Gordon growth model, constant growth model approach, salvage value, or none of them?
B.
B, yes, exactly. So because this is one of the method, majorly used method, Gordon growth model method. And FCFE refers to cash flows available to equity shareholders, preference shareholders, lenders, none of them.
Yeah.
Exactly, correct. The next one, that is a 12th question. Dash is generally used for valuing intangible asset, that is leading or the most significant intangible asset out of the group of intangible asset being valued. DCF, relief from royalty, multi-period excess earning method, or all of the above?
Suresh Kumar.
Come on.
D, C.
Yes, C is the correct answer. As I said, the multi-period excess method will be calculated generally for valuing the leading or a most significant intangible asset. Incremental cash flows of the leading asset. The next one, the 13th one, dash is a valuation approach that uses prices and other relevant information generated by market transactions involving identical or comparable assets, liabilities, or a group of assets and liabilities such as business.
Somebody says C.
Yes, exactly. Once we see the market transaction, obviously it will be related to the market approach. And the 14th one, dash that are developed using market data, such as publicly traded available information about actual events or transactions, and that reflect the assumptions that market participant would use when pricing the asset or liability.
A, somebody using A.
Which one? 14.
14
Yeah.
for A?
Yes.
Okay.
14. Because it is the using marketable data, or obviously whenever we use the data, we use the observable inputs. The next one is the comparable transaction method, also known as the dash method, utilizes information on transactions involving assets that are the same or similar to the subject asset to arrive at an indication value. The same or similar asset. So guideline transaction method, prior transaction method, guideline public company method, or market method.
A, C.
Yeah. A is the correct answer because it is related to the transactions, comparable transactions. Obviously, it would be guideline transaction method. Because only two methods are there in the market approach, guideline transaction method and the public comparable company method. And the next one is a dash is a valuation approach that reflects the amount that would be required currently to replace the service capacity of an asset. Which one?
B,
cost approach. Okay, replacement cost. The 17th one, how many methods of cost approach which is broadly used? 2, 5, 3, 4.
Everybody saying 3.
Yes, exactly 3. Because the word is used as broadly, obviously it would be 3 only. And IVS, 105 for IVS. The 18th question, dash involves valuing an asset based on the cost that a market participant shall have to incur to recreate a replica of the asset to be valued, adjusted for obsolescence. Replacement, reproduction, summation, prior transaction.
B.
Recreate a replica means reproduction, otherwise replacing. The 19th question, that is the dash involves valuing an asset based on cost that a market participant shall have to incur to recreate an asset with substantially the same utility. So recreate an asset with substantially same utility. So which method? Replacement, reproduction, summation, prior transaction.
A. B.
Exactly.
Most of them are saying A.
Dash represents the present value at the end of the explicit forecast period of all subsequent cash flows to the end of the life of the asset or into perpetuity if the asset has an indefinite life. Liquidation terminal value, premises value, all of the above, which would be the option. The present value at the end of the explicit forecast period. Sir, answer. B. Yes, it's a terminal value.
Okay.
And the next one, only this is the no, 2 questions are 22 questions are there.
Okay.
Which of the following adjustments are applied to reflect differences between the comparable and the subject asset with regard to the ability to make decisions and the changes that can be made as a result of exercising control? DLOM, DLOC, control premiums, or A and B? B. Lack of control.
Yes.
And the next question is where more than one approach or method is used, or even multiple methods within a single approach, the conclusion of value based on those multiple approaches methods should be Correct, exact, reasonable, accurate.
It is C.
Yes, exactly. Thank you, everyone. I don't know whether you have answered based upon no after this session, or you would have already thoroughly studied the subject. Thank you, everyone, and I wish you all the best for your exams. And I wish to see you all as a valuers when I meet in you people in the Vijayawada. Thank you, sir.
Thank you, ma'am. Thank you very much. Our delegates are more enterprising and entertaining also. Thank you very much for your excellent presentation on the valuation approaches. You have taken enough care and R&D in doing all those presenting and all those things. I request you to kindly place your this PPT also in the this thing in the group, so that everyone will get benefited out of it. Thank you very much for gracing here and informing about the things. And now it is turned to our Hemant sir, and it is regarding this equity valuations and connecting case studies. And BL Chakravarti sir, after 7 o'clock, he will be dealing with the other case studies which are left out by the all those other case studies which are left out in regarding the valuation. Thank you, sir. And over to our Shrita Shireen ma'am for introducing Hemant sir to our delegates.
Glad to introduce today's speaker, CA Hemant Kumar. He is a practicing chartered accountant, promoter and founder of Measures Hemant and Co. Chartered Accountants, Chennai. He is a member of Institute of Chartered Accountants of India, and he is a certified forensic auditor from ICAI and certified concurrent auditor for banks from ICAI and insolvency professional from IBBA and qualified registered valuation professional from IBBA, and he is qualified independent director registered at the Directors Data Bank IICA, and he has vast experience in consultancy of both direct and indirect taxes and handling corporate affairs related areas in different areas. And he is convener of Anna Nagar CPE Study Circle of SARC of ICAI for the financial year 2020-21. And he was co-opted member of SARC Regional Council for the Students Committee of SARC for the year 1920. And he is past co-opted member of Regional Council for the Editorial Board of SARC for the year 2016 and 17. And he is regular speaker on different professional topics and at different CPE circles and branches of ICAI and ICWA, etc., as well as Tamil TV channels. With this brief introduction, I request Hemant sir to present upon the topic.
Thank you very much, madam, my good friend at Insolvency Professional. Outside, let me register my sincere thanks and appreciation for the Vijayawada branch of SARs of ACA for come out with the wonderful idea of this training session on valuation, especially this is wonderful in this Navaratri Utsav. Whether it's a coincidental or it's a planned program, I don't know. I'm seeing the list of faculties. There are 9 faculties for 9 days, 9 Navaratri days. So today, Navaratri day 4, I am the faculty number 4. It's a good opportunity for me. Thanks to all office bearers of the Vijayawada branch, as well as the regional council members and central council member, Professor Kumar ji, for giving this wonderful opportunity. I don't want to take much time or taking up the today portion which they given to me, and madam successfully could able to complete her 2020 match, but I had to complete my 10 hours match because the topic which given to me is very big one, and the time which given is 1 hour, which I'll try my level best to keeping a view that all of the members already undergone 50 hours of training and a basic understanding about what exactly the valuation of equity shares. Okay. Straight away, I'll go to without wasting of much time. Thank you very much, friends. Good evening to all. I request the panelists to, if you could able to give a chance to all participants to speak. It should be an interactive session. I don't mind. All participants are very mature people. They'll kept in mute. Whenever those who want to talk, they will talk with me. Is it possible to unmute all members?
Yes, sir. It is unmuted, sir. There is no problem. It is a webinar model. They will be unmuted. And if they ask, raise a hand.
Fantastic, sir. That's enough for me. Friends, this is an opportunity for us to talk each other. There is no one side. Out of my 1 hour session, almost half an hour you have to speak. Only half an hour I'm going to speak. You are going to do it because you are going to write the examination. You only choose for this profession. Fantastic. As far as the valuation examination is concerned, the valuation portion which given to me is the equity valuation. First, we have to understand what is the syllabus out of if you want to pass any examination. First and foremost, we have to understand the entire syllabus. By the time you already know what exactly the syllabus is, as far as the new syllabus is concerned. One second, I'll just start sharing my. Okay, I think you can able to view it. Fantastic. Able to view, sir?
No, sir. You came out the screen sharing, sir.
Okay. Now?
Only white screen is coming, sir.
It's not coming still?
Only white screen is coming, sir.
Okay.
I think it is whiteboard or something like that.
Okay, I'm sorry.
Select entire screen, sir.
I got it.
Yeah, now it is okay, sir.
Okay.
You can maximize the things.
Yeah. This thing Excel you can able to see, sir?
Sir?
Excel?
Yeah, you can also.
No, Excel. No, I can do it. You can able to see the Excel?
Oh, you can able to. Yes, sir. Now it is okay. Now
Okay.
you can able to see.
Yeah.
This.
Friends, anyone could tell me how many topics are there in your syllabus? How many topics are there in your syllabus? Friends, open, unmute and can speak. I request members to participate.
They can put it in the chat box also.
They can speak. No problem.
No, sir. Everybody is unmuted, sir. If you want, I can.
That's what I want a lot of people to unmute all, and whoever want to speak, let them speak.
Okay.
Let them hear the voice. Let create a classroom atmosphere so that it will be one-to-one interaction, not chat box. Is it okay?
Yes, sir.
Yeah. Hello?
1 second, sir.
Yeah.
I'm just doing the things. Sir, you go ahead, sir. I'll just interview you about this.
Yeah, I think you know the topics which are covered. And if you take microeconomics, these are the subtopics. This is the, again, topic-wise, area-wise, if you could able to bifurcate your syllabus. I think if anyone did this exercise, if you could able to do this exercise.
Hello.
Yeah, this is the facts. So you have 295 topics, almost all 300 topics are there. And if you take topic wise, this is a topic wise. So you are expected to be study these all 300 topics to write your 100 marks your examination.
Okay.
So why I given this particular thing, you want to do your preparation. The first step, which I generally recommend of all my members who are attending my classes, take printout of your syllabus first, understand your syllabus, topic wise, chapter wise, and weightage wise, do your APC analysis and find out your number and fix out it, and then you proceed further on this. So coming to my today's topic, which they given to me is overall value evaluation. Just completed madam's approaches, cost approach, all the things madam is completed. Now valuation applications. In valuation application, equity valuation is the very core area. This is the topic which I'm going to handle today. Business combination, appropriation, cost of capital. Yeah, this is the topic which I'm going to handle for the day. For the examination point of view, this is very, very important, which consists of total applications consist of 35 marks. Out of 35 marks, if you see as far as this is concerned, 9 marks pertaining to this equity valuation. So 9 marks plus apart from 9 marks, you will have the case studies also. Minimum 1 case study you will get from this. Out of the 320 marks, you will get minimum 6 marks to 12 marks. You will get, let us say, 10 marks. So 9 plus 10, 15 marks comes if you take even 1 case study also, 15 marks will cover on the equity valuation. Number 1. So probably I can understand the panelist idea. If you allow people, they are not unmuted. Mute is the problem. So you mute it, sir. will go along with your idea.
No, sir. I think everybody I have unmuted.
Somebody is talking.
Yeah.
Imports ke exports ke zero
Okay, fine. Okay, this is the 9 marks which we are supposed to be. So 9 plus 6, 15 marks is the area which I'm going to cover it. So this is the marks. So even if you want to go one step further, I'll show you one interesting thing. The total syllabus, if you are bifurcating into mark wise, if you take chapter wise, mark number 1, question number 2, question number 3, question number 4. So this is the mark wise analysis also, some extent we can able to do it. So as far as for example, this is concerned, 9 marks consist of what we are going to discuss another half an hour time. So definitely difficult, but we will try to what exactly it requires. So your 100 marks, entire 100 marks are divided. So if your preparation starter, for example, if you read business cycle, phase of business, yield curve, you'll get 1 mark.
Sir, that Excel got fumbled, sir. Now we are not able to see the Excel correctly.
Yeah. Now I'm showing. Yeah. Now I'm showing new one.
Yeah.
I don't know. Now I'll go to the directly without wasting further time when keeping this indexed.
Sir, we are not able to see the Excel properly, sir.
Oh no. Okay. I'm going to straight away start on my topic now.
PPT. Okay, sir. Yeah. Shall I put them on the mute, sir?
If they have a discipline of muting themselves safely, it's okay. Or else I'll.
Okay. We'll request everyone, request all the delegates. Sir is asking to participate. I request everyone to kindly mute yourself and please unmute yourself when there is a demand from this, sir. Okay?
Thank you. So this is the area which we are going to have the 9 marks. As far as your syllabus is concerned, equity and business valuation is concerned. There are the areas calling of analysis of the business environment, business strategies, and forecast, cash flow statement, and cost of capital and returns, cost valuation adjustments.
Sir, better you unmute, sir. All the people.
Unmute. I agree with the panelists. Unmute.
So thing is,
unmute, sir.
Lot of sounds are coming, sir.
Understood. Unmute all, and whenever there is no option for us. Generally, if it's have an interaction, that will be more interesting. But no chance.
So, 80 plus guys are there on the line.
No issue. Fantastic. We'll continue, sir. No disturbance for the next few minutes. Okay. These are the. Pardon? So okay, these are the areas which we are going to have. If you want to have good English, you should have BAT, BAT, CAT, CAT. First, you should know the alphabets of A, B, C, D. Like the same way, if you want to know about valuation, we should know about the basic fundamentals of valuation related topics of equity valuation. This is a fundamental how in the case of audit, how you do the initial programming, knowledge of the business or other steps before pre-audit, which you are supposed to do. So those stuff we in the valuation is also not exception for that. We are supposed to do some set of activities. These are the things which are required. Friends, as I told you, not only for the examination point of view, after completing your valuation course, when you put in live, whether you're doing optional derivatives valuation in future or not, I don't know. But definitely a valuer in at least couple of assignments you do in a month for equity valuation, whether it may be for the CCD or any other purpose of companies or IBC or any other course, equity valuation absolutely necessary for your day-to-day affairs. So let us understand what basic fundamental things before we starting up for fundamental thing before starting off thing. These are the theoretical concepts. We'll get 9 marks out of this. So you are supposed to understand the theoretical concept and one by one topic you have to study and make yourself comfortable before writing this thing. This is very simple, but at the same time, if you are not able to understand and spend some time on the these theoretical concepts, you will not get marks. You know about business environment analysis, BEA. That means whenever you want to do the valuation of the particular thing, once you receive a call from any customer, that immediately you would start the framing and take the DCF method and calculating projections and find out the numbers, discounting some 10% as the standard discounting factor and marrying values and whatever, how much you want values are based on that value, adjusting things and find out a number and giving. No, you should not do it. First, unlike as an audit, you're supposed to have your own set of pre-audit related things, how to analyze about the company, audit strategies to be used. The same way you have to do the basic fundamental master file. I'm taking you lively with the practically because the theoretical subject. I'll take you practically with the theoretical mixing of and make the topic more lively. Once, if you want to do any valuation of equity, first you create an Excel file creating related to the company a master file. Master file consists of like your permanent file, all data related to the company, name of the company, SIN number, GST number, PAN number, XYZ, director structuring, how they're doing it, organization structure, all the stuff, whatever information you are able to get it from the company, kindly keep it in the Excel file, master file. Two, very important thing is you have to understand about the company, about we call it as a BEA. We have the two sets of understanding of the environment, like external environment, internal environments, external factors like legal, technical, social, pest, we call it as a pest analysis, political, economical, social, technical analysis. So internally, for example, today Corona is there, no one is walking, no one is going out, business drastically come out, which is a social factor, and which is a pandemic situation, no one guessed, which is significantly influence on the business. The valuations which are done before the Corona, or the calculations of strategies which are used and numbers which are the projections are absolutely come down back. So to understand better way, we have to understand about the business, and we understand the external factors which are significantly influence on the business. For example, if you take leather business, especially in the case of Punjab side and Rajasthan, that belt of border area of Pakistan and India, leather is the main product which they are doing industry for them importing the material. The relation between the India and Pakistan is good. Then the business plans were made and valuations are made in Gujarat one company. And the moment we have a fight with the Pakistan small issue, then immediately dumping some ratio, some cost, they push on the and all banned leather from the Pakistan to India. Then entire industry, the imported material from Pakistan was gone. So there is a significant influence on the external factors on the company. If you take South, if you take Kerala, we don't know when strike's going to come. So social environment, social factors will be significantly influence on the business, and when significantly influence on the business, significantly be influence on your valuation also. While doing your discounting factor, all these factors to be considered. Second one, we know everyone about the SWOT analysis, strength, weakness, opportunity, threats. So like, unlike for the individual company or resume, how you have the SWOT analysis, the same way you have to have your SWOT, strength, weakness, and opportunity threats. All things you have to jot out when you have the initial discussion with the management. All points should be jotted out in one set of rate and one set of the weaknesses on threats we have to find out. If more numbers and your discounting factor significantly influence in your value also significantly go up. And on the other hand, if your weaknesses or threats are more in the company where you're doing the valuation, that significantly it will influence on the discounting factor as well the value also. So SWOT analysis is the one which maybe not theoretically, practically also, if you could able to put and in the paper, discussing is different. Putting the odd analysis you made with the discussion with the management, put in the paper, and then significantly influence in easing your work of what exactly your outcome of the evaluation. And in examination, they may ask you questions on SWOT. They may ask me questions on your pest. What is meant by pest analysis dash? Political, economical, social, threat. These type of questions may be expected. It's very simple, but only thing is one round of reading is important. So next question, which material has to be? There are different materials available in the market, as well as some reputed register value or organizations issued study material. Even one step further, one material available in the IBBA website also. So any choice which you are best you feel, you choose the one best material and take the one best material, choose it, finalize it, and that material, try to understand once, and you know the syllabus, take a printout of your syllabus and the Excel file, keep with you. Then again, you go back and study one by one and find out this particular thing. So it will be ease up your preparation. Apart from this, there is a requirement to study for the equity valuation, some set of strategies. Out of the strategies, one of the biggest strategy is Michael Porter. You might be studied Boston School, in that there is a different concepts are issued. In that, one of the biggest theory is this Michael Porter 5 source theory. This is very important, friends, not only for the examination for the 1 mark question. It is very important. Even sometimes they may not. Sometimes there is a possibility to ask in the case study also. I repeat, there is a possibility to ask case study on this particular strategy also. So the concepts of the strategy you should to understand. As far as this strategy is concerned, you have to understand the business of the particular industry in the 5 forces. Whether it's a buyer's market, whether it's a supplier's market. Yes, today's real estate is the buyer's market. Supplier's market, yes, it's a supplier's market. It is if you take medicines, is a supplier's market. And threat for the new entry. Everybody, there is a possibility of new people, new generation going to come at any point of time. New things will come in the picture. Threat for the substitute. There will be substitute for everyone, including God. So we have to see that particular business, what are sort of substitutes are available to take the particular business to throwing out into different way. For example, for substitute from presently for the case of motor vehicles, presently motor vehicles in diesel, petrol, electricity today, and tomorrow by water. The day after tomorrow by air. There is a possibility, and technology goes on, so on, and things are going upgrading, and things will be substituted. So we have to understand which industry we are doing evaluation, and what sort of substitute going to be possibility to take the business out. If business going to go out, especially in the case of companies like software companies, technology companies, where rapid growth will be there, rapid changes will be there, rapid movements will be there, where you have to be analyzed in a very nice way by using this particular thing, strategy, and analyze what sort of substitute that will be depend upon for your valuation criteria and parameters. And competition rivalry, what is the present existing competition rivalry? What is the rivalry between the chartered accountants now? When new chartered accountants are coming in, new entry, what could be the possibility? What number will going to come? What is the business volume going to increase? How it going to be sustained the industry of chartered accountants or industry of registered value or profession? So this is our strategies. Like the same way we had to apply for the company where you are doing your evaluation, and strategies company following on that. And another strategy is Mackey 3. There's a nine matrix of thing. One matrix talking about competition of the strengths of the unions. Another matrix talking about industrial activities. If it is a small, high levels of competition is there, low level of industrial activities, what to do? Protect. And if it is a low level of competition is there and high level of low level of industrial activities, just slightly divert it. So what sort of decision you have to take as a management point of view? What sort of decision is company is taking it? So that will be make sense on understanding of the valuer and make a decision of how to value the better way of the particular company. Another way of strategy is ADL matrix. Instead of 3+3, it's having 4 levels of different aging of industries. Industry when it is enrolling and growing, maturing, aging. Another hand, it is the weak, it's the tenable, favorable, strong, dominant. And in these situations, what sort of decisions company has to be taken into, and what sort of decisions company is taking in. So this is the theoretical things we have to study in that. Another very interesting one, examination point of view, will get questions, 1 mark questions in BCG matrix. We call as a cash cow, generally cash cow. And there will be, if you divided your total industry in the particular company, if you take 4 set of divisions or 4 set of products, if you take like one product we call as a dog, one product we call question mark, one called stars, one called cash cow. If you take Apple products, I generally give the example of Apple products. Apple have a different type of products. One, cell phones, they have MacBooks, they have iPads, they have iPods and iPads. So generally, in case of generally mobile phones are the very thing which you are a star. We can do any point of stage. Everyone will love to have. It's a social symbol. People will feel. So we'll have a star rate of things in the. We have a growth of a high level of the market is there. In the case of iPhones, iPads, it may be cash cow. We have to invest something and we'll get extract maximum when the mood is there and by introducing a new thing. And iPods already MP3, 4, MP5, all are outdated. No one going to hear about that. It's a question mark of docs which have to be thrown out of something. And MacBooks, which are the thing which have to invest more money and few very limited market, very limited thing. It's a question mark. I'm just giving an example. It may be this side, that side. Products maybe. For understanding purpose, I'm just giving. It's a question mark whether that continue with the particular product of MacBook or not is a question mark. So by using the matrix, we can decide which product, which level, how to take it up and do it up. So this type of strategies we have to make it up before doing your valuation. And apart from that, we have to understand about business combination when we require the valuation. The valuations are required when you're doing a business combinations, amalgamation. Valuation is not a new profession. It's already there earlier also. It's only branded in 2018, 17, saying that on 18th October 2017 is what come out and notified as a register value in the Companies Act. And section was 247 was given the links. Yesterday you've seen all these things. Amalgamation, two or more companies join together and having merger and taking to a new company, a different way, is amalgamation. You might be studied amalgamation. What is the accounting standard? What is the accounting standard? What is the accounting standard for amalgamation? Indian accounting standards?
Accounting standard is 4, India's is different.
Accounting standard? 14 is correct. And the question may come like this, and the question may come, what is the difference between amalgamation of purchase and amalgamation of merger?
There are 6 conditions in accounting standard 14. If all the conditions are fulfilled, then it is a pooling of interest method, else it is a purchase method.
Correct. So you are expected to be know all these 4, 5, 6 models, whatever the conditions, all others will be go. That 90% of the shareholders should be the 90% shareholders of that company. On all other such liabilities should be transferred. Like whatever conditions are there, all these conditions we have to study first. We have in examination, there is a possibility to ask questions on particular area. What are the, whether it's a amalgamation of in the say merger or amalgamation of mere purchases, all these questions may come. So all these things we already know. Merger and 2 or more things are joined together and form a new company, or merging into one company with another company called mergers. So this is very, very important examination point of view. There are 5 types of mergers: horizontal merger, vertical merger, conglomerate merger, and cogeneric merger, and market extension. Horizontal merger, 2 or more similar company, one chart account joined together and forming a new company. One real estate company joined together and taking up a new company is called horizontal merger. Vertical merger or manufacturing company, one production supplier to the manufacturing company, one manufacturing company, one supplier to the manufacturing company. So making a synergy, why mergers and acquisition will happen? To having better synergy or financial or what type of, no, it may be different type of things. So all marketing synergy, all type of synergy ke liye will have a mergers on that. So this supplier will mingle with the manufacturer is called vertical merger. It's not horizontal, vertical merger. And conglomerate merger is a merger between 2 or more company and engaged in different unrelated business. One is called one industry for real estate industry. One is gold industry, merging together and form a new company. Facebook and another one, Reliance is joined together and form new company. So these type of things will have no relation between one company, taking a new shape of the new company. And cogeneric merger is known as a product extension of merger, already having mergers into 2 or more companies operate in the same market sector. For example, if you're having in North India one set of market and South India, and cogeneric merger and market extension type of merger occur between the company that sells the same product but company in different markets. So North market, South market, East market, that is market extension. And cognizant merger, R&D and different companies join together, forming companies. This is very important. From this slide, you will get one single question. Make note, from this slide, you will get one single question. Next. Demerger from big company, one company going out and doing a new form of thing, it's called demerger. Apart from that, we had to understand forecasting. What is meant by forecasting? We are estimating the future and the numbers with having some basis. Generally, forecasting, what we will do, we have a growth rate of 10%. So whatever base numbers we'll have, generally we'll take 10%. What is 10%? How it will arrive growth rate, for how you are forecasting in the future. So let us have some understanding there. There are 2 methods of the forecasting, estimating of future. One, quantitative forecasting methods. 2, qualitative forecasting methods. Qualitative forecasting methods are one we call NAVI approach. So NAVI approach is nothing but last year we have a 20% of the growth rate. This year we'll take 20% flat. That's called NAVI approach. Moving average, last 3 quarters average you will take 10%, 20%, 20%, 30%. Average you will take and current year analyzing based on that and taking value of that. Expansional smoothing method is having 2-3 criteria based into consideration and arriving with the scientific formula and giving a weightages. By giving weightages and arriving the values of expansion smoothing method. Trend projection, keeping the last year trend and finding out the trend is the expansion smoothing model formulas. And qualitative forecasting methods like executive opinion, a set of people sat together, executive team, and discussing, and board of directors sat and discussing on a particular topic and identify some value and bringing the number is called executive method. Delphi method, I can give example like cricket match. First innings are completed, second innings was started. And some experts sat together and discussed in first 10 overs, if you could able to get six average, you will get Billman. Or else second bowling side, if you do 5 wickets down, you will get this. So some estimation based on the some criteria on estimating the future forecasting is called qualitative forecasting or Delphi method. Sales forecasting, nothing but sales team sat together and finding out the value and estimating the value based on the sales production and sales utilization rate. And consumer survey, going to the end user, like in the case of polling, we'll go to the election. After completing the election, we'll go to the consumer and we identified some survey and identify some estimations, which party will win. The same way, understanding and forecasting future is called consumer forecasting. And cash flow statement. Cash flow statement, what is the accounting standard? Again, same question will come. Cash flow statement.
Accounting standard 3.
Accounting standard 3. Very good. So questions may come like how many types of cash flows? How many types of cash flows?
3.
Cash flows are only 2. There are only
types.
1, but 2 methods are for calculating the cash flows.
How many types of cash flows? Question is
3 types.
Operating.
Three types, sir.
Okay. 3 types. Operating, investing, and
so question will come 2, 3, 4, 5. So in examination, question will come 2, 3, 4, 5. So how many types?
3.
It's only 3.
3 or 2?
3 only.
3 only. So
3,
what
sir.
is 2? Then what is 2?
2
Two is the
are
methods.
cost.
What is direct method?
Direct and indirect methods.
Then what is 2? What is 3?
Cash flows are 3 and calculating methods are 2. Direct,
Calculated for what?
like arriving cash flows, direct method and indirect method.
Okay, good. So there are 3 cash flow methods. Not 3. There are 3 cash flows. Sorry, there are 3 cash flows. Cash flow from operating activity, cash flow from investment activity, cash flow from financial activity. Under cash flow from operating activity, there are 2 methods. Under cash flow from operating activity, whether direct method or indirect method, to arrive the values of operating activity. And in the case of investment activity, financial, everyone knows about what are the areas will come, what are the topics will come, what are the events, what are the points will come under investment activity, what are the points will come under financial activity, what are the points will come operating activity. Very, very important. Now I'm introducing slowly the point number 1, cash flow from operating activity, CFO. Cash flow from operating activity, CFO. Kindly note down and in our discussion next, I have a half an hour discussion. CFO will be introduced. CFO is nothing but cash flow from operating activity, net profit adjusting with net working capital adjustments, and capex, whatever is there, we'll adjust. Net working capital is the up to that level, we'll call as it. And whatever adjustment we'll do, non-cash flows, that is depreciation, non-cash flows. Non-cash flows is also be adjusted. We'll calculate this one. Everybody knows. I don't want to spend much time on that. Now, another last one, madam also taken time to discuss about this. Discount, lack of control, and discount, lack of materiality. If your time permits, kindly note down very quickly the formulas of discount, lack of control, and discount, lack of materiality. Marketability. DLOC is equal to 1 minus.
Sir, you will be anyhow giving the PPT, no, sir?
Yes, we can share it over. If at all you want to note down, note down.
Okay.
So the difference between different discount, lack of control, discount, lack of marketability, in one word, very quick thing. Discount, lack of marketability, as far as we can give an example, like in the case of 2 portfolios are there, especially this DLOIM will come into the market approach. So DLOIM talking about if you have a investment, let us say 10 lakh rupee, I have an investment. I have a 2 possibility of avenues. One avenue, which is one opportunity, one option is a listed company. Second opportunity, we have unlisted company. So as an investor point of view, if you know discount, lack of marketability means which company will have the more marketability, definitely as an investor will prefer to invest it. So compared to that company, other company having the disadvantage or discounting or discounting factor to be considered for the purpose of control factor to be considered for the purpose of marketability of the particular shares. Even if you purchase now, tomorrow, if your property in the main road, you definitely have a better edge comparatively inside in the particular road. front facing property will have a better marketability compared to backside face property. So DLOM, talking about a discounting factor, when you're doing a market multiple method, we are using DLOM is the market discount lack of marketability. Controllability, even the same example, if you take listed company, unlisted company, in case of if same investment of 10 lakhs, you are having it. And if you're giving investment in a company where if you take two companies, even both are unlisted companies, in one company, if you invest the same 10 lakhs, you will get 80% of the shares. And another company, if you invest, you will get 15% of the shares. Then your controllability loss, you are not having a decision power in the company. In the other company, first company, you will have the decision power. This make a sense on that. And because of that discounting factor, what level of things we have to give is called as the formula will be already there, discount lack of control. So the next one is very important one is cost of capital. Cost of capital is very, very important topic. Now we have to understand the okay. So with cost of capital, we have to understand 3 points here. Cost of content. So one is okay. So what is the difference between expected rate of return, cost of capital, and what is expected rate of return? Sorry, I could not able to get. Okay, what is expected rate of return, and what is meant by cost of capital, and what is meant by return on equity? What is the difference between these three? One is expected rate of return, expected rate of return, 2 cost of capital, 3 return on equity or return on capital. What is the difference between these three? Anybody? Participants? Participants? I could not able to see the answers.
Mr. Ramak,
yes, sir.
not exactly.
Tell me, sir. So what is the difference between expected rate of return, what is meant by cost of capital, and what is meant by return on equity?
My dear participants, you can unmute yourself and you can talk to him.
Sir, expected rate of return is nothing but the market. What is the expecting the investment? When you invest money, what is the return I'm expecting? Cost of capital is the other way around. The company, what is the cost it has to pay the inflow fund? Very good.
And return on investment?
Return on investment, like on project, whatever that whole firm.
So expected of return and cost of capital should be more than the expected of return?
No.
Hello?
No.
Not required. Okay, very good. So sir is given a wonderful thing. Expected rate of return is in the perspective of the investor, and cost of capital in the expected rate of return is investor point of view, and cost of capital company point of view. Return on equity, return on investment is after post event. So after one point of stage, what we get, so what we getting from, so probably as an investor, I may be expected any range, whatever the source I'm having it, as rightly said. So from the investor point of view, what I'm expecting from the company by doing my, nothing will come free of cost. By investing into a particular company, what I'm going to get from the company is called expected return. So when an investor expecting something from the company, let us say 15% I'm expecting. For example, if it's 15% expecting from the company, then as a company, if I could not able to match the expectation of the investor, either at least 15% or more, then only investor come and invest in my company. If investors are expected 15%, if I could able to produce only 10%, if could able to give 10%, whether any company will come and forward and invest in my company, no company will come, no investor will come and invest in my company. So based on this fundamental assumption, the total premises of formula called CAPM, capital asset pricing model was formed. That means capital asset pricing model portfolio management theory was formed in such a fundamental assumption that the expected rate of return is equal to cost of capital. Expected of rate of return is equal to cost of capital. Because if you could not able to produce the what expected by the shareholders, we cannot able to conclude that one. So this is the fundamental one. And number two, in the case of company, so next another fundamental things I will take. So if you want to run the company, there is a two things. One, we require assets, and there will be liabilities. These assets may be fixed assets, or it may be working capital, day-to-day affair. If, for example, if you want to run the company, we require fixed assets as well as the working capital. So someone has to provide this money to run this company. Who will provide? There will be a capital structure in the company. Who will provide? One, equity
investors, shareholders.
Fantastic. Equity
debenture.
And outside funds like bankers or debentures.
Fantastic.
Loans.
Debentures. Fantastic. Or bankers. And you can say
retained earnings.
Sundry creditors for the working capital. Fantastic. Yes. So in the case of sundry creditors, so they have the profitability, they will get the money for the day to offer. So that is the reason we call in the IBC language as operational creditor. Operational creditors. In the case of debt, bank funding and other people who are funding it, we call it as financial creditors. And in the case of preferential shares, and what is the expectation out of this? You will get profit out of their sundry creditors. Profit is the expectation. So nothing will come free of cost. And in the case of financial creditors, as a bank or debentures, what is the return?
Interest.
Interest is the return. So this interest is a fixed or variable?
Variable.
Interest is a fixed or variable?
No. Interest rate will be fixed. And
interest always be fixed. In few cases, semi-variable.
Yes.
Semi-variable. In the case of preferential shares, it is also fixed in nature.
Fixed.
It is also fixed in nature. And this one,
variable.
Absolutely, this is a variable. There is no fixed at all. Invariably, it is absolutely variable. It will not be fixed in sense. And that is the reason, if you see your syllabus also very carefully, the portion pertaining to preferential share calculation and debenture calculation, we can as a fixed income securities. Which one? Which going to handle by the Gopalakrishna Raju sir tomorrow. This is consist of 9 marks. And the portion which we are going to handle is equity valuation, which is consist of 9 marks, plus minimum 1 case study, 6 marks, total 15 marks you will get out of this. Understood? So nothing comes free of cost. Even if you see that IPC code also, if this financial creditors representative board of directors drastically failed in repaying debt or financial creditors or operational creditors, rupees earlier 1 lakh, now it is 1 crore above, then the board of directors will be suspended on behalf of the financial creditors, operational creditors. Next one will take charge to represent on behalf of the company, and these people will be calm down. So that is the logic behind this thing. So this people is the structuring. If a company structuring having both, next formula number 2, both equity as well as debt, we called as a what we call
equity.
We have a liquid companies, and if you have only equity traditional company, unleveraged levered company, we call as a levered, and only equity we called as a unlevered companies.
Unlevered.
Clear? So levered company, unlevered company also I made it clear. Okay, now we'll go back to that thing. Okay, I don't want to tell things about cost of capital, about equity, the formulas of equity, you know that. And equity in India, we have a income tax benefit. So we'll wherever equity is there, debt is there. Sorry, wherever debt is there, that interest portion is eligible for income tax benefit. Wherever income tax benefit, there are two terminologies in the financial management. One is accountant, two financial manager. Financial manager. One, when you go for when we have the quote of as a valuer, you are a typical financial analyst. So definitely you should think even Naya Paise exactly what benefit exactly going to the shareholder point of view or investor point of view. That is the reason we are giving benefit of the income tax and discounting the factor. And in the case of preferential shares, it is a redeemable, what sort of formula? So you don't have any redeemable concept here, only for theoretical you can know. So these two things, just tomorrow we'll have a discussion. Now we'll come to the cost of equity. Cost of equity is concerned, there are two things. One is we have two methodologies. One, if you go for growth model, and I'll go to use that slide. I'll use the slide. Then again, I'll use the slide, whiteboard. Yeah. Again, I use the slide. So just now, a few minutes back, Madam given wonderfully the methodologies. I don't want to again go into describe about methodologies. Methods, there are three methods. One, cost approach. Two, market approach. Income approach. Under cost approach, it's very simple, easy to understand. Intrinsic value, fair value of assets minus liability. Sorry, I could not able to get it properly. Liability, you will get net worth. That is anything but total net worth divided by number of shares. You will get intrinsic value. So we'll arrive the value cost method. And market method, by using different multiples, we are arriving the values and finding out the values. I think Madam discussed very nicely. Under income method, there are two methods invariably people will be used for examination point of view. One, dividend distribution method, DDM, and another method is cash flow method, CF, cash flow methods. Under dividend distribution method, I can say if a company is having no growth and if a company having a growth. Under company having growth, again two models. I can say constant growth, and two stage and three stage. And here we have two methods, FCFF. Please bear with my English because I don't have mouse. I'm just trying to give something. FCFE. FCFE. Okay. Examination point of view, you will get questions out of FEFE and FEFF or three-stage model growth model from our market multiples. This is good if you could able to understand these three. Done, over. I repeat, 1, 2, 3. These are the three models. Generally, invariably, in the case of equity valuation, your possibility of getting questions out of this. So we'll try to work out. Time permits, 10 minutes is there. Is there any possibility to take another 5-10 minutes? If you give a chance, at least one question I can try.
Yes,
Yes,
sir.
sir. Yes, sir. Yes, sir. You can proceed.
Sure, permit.
5 minutes.
Yeah, 5-10 minutes. We'll take it up now. 5-10 minutes.
Take 5 minutes, sir. Not more than that, please.
Yeah,
Sir.
no problem. Okay, so first question we'll take it up. First question, first model. We'll try. Where is that? What is that? Okay, we'll do it. We'll take note down, sir. If a company having a constant growth, kindly note down. If a company having a constant growth rate, and I'll go this. Okay, able to see, sir? No.
No, sir, not able to.
No, sir.
Okay, no problem. I'll show it. Then I'll do what to do. I'll take Excel. And I'll take Excel. You can able to see Excel?
No, sir.
No, sir. No.
No, okay, same problem. Okay, now we can see. Yeah.
Yes,
You can
sir.
see? Yeah. Okay. Okay. So a ABC company, traditional company having no plans and paying that 12% per annum as a dividend for inception. Say if the company paying 12% forever in the lifetime and they're not going to have any type of growth in the company. So what is the cost of capital? Simple.
12%.
12%. Nothing going to happen because same way the fundamental of what we are going to get from that company, the same going to get from this company also. Okay, I'll take straight away and go from here. That's better. Because I don't have time. Okay. Now, what file able to see, sir? What file? What file you can able to see?
No,
No,
sir.
sir. No, no.
I repeat. Sorry. There's a problem in that.
Excel only.
Now, sir.
It's only
No, no.
Excel showing.
Now
Yeah,
you can able to see what file?
No,
No,
only
sir.
Yes,
No.
yes, word file we are able to see.
Question
No
number
growth.
1. No growth.
No growth. Yes, we are able to
Yeah,
see.
we completed this. Now we'll go constant growth. So in the financial management, there is no one signal formula. If a company has, there are two stages of, I said, growth rate with constantly. If you no growth rate, not having a growth rate constantly. If a company having a no growth constantly, there is no formula in the financial management. If a company having a constant growth rate, then only we have a formula in the financial management. Cost of equity is equal to, what is the formula? Under growth rate
D by P plus G.
Yeah. So we know the formulas. Now try to attend this question, sir. Constant growth rate. DF having growth rate of 10 rupees, having equity share of 10 rupees each. Company
Sir,
paid.
we are unable to see, sir. We are unable to see anything.
One more time.
We are unable to see, sir.
Now, sir.
No, no.
Oh, 1 second.
Now you are visible, sir.
Very good. Now, sir.
Yes, sir.
Now,
Perfect.
now.
Perfect.
Yes.
Okay. So because I don't have time, at least this is 3 hours topic. Actually, generally I used to take 3 hours. You want me to take 1 hour? Even I could not complete even 30-40% also. Fair enough, no problem. Now tell me, sir, what is the answer out of this? DEF having equity share of 10 rupees each. Last 7 rupees. Last year they paid 7 rupees and expected growth rate of 12% constantly forever. Cost of equity is 15 rupees. Find out what is the equity share per share. What is the formula?
D by P plus G.
So formula for to find out the MP0 is equal to DP1 divided by cost of equity minus growth. This is the formula. So what is the answer? DP1 divided by upon cost of equity minus growth. Even if I change my thing again, I'll go things. So DP1, what is the DP0? What is DP0? Dividend paid in the current year is 7 rupees. DP1 means dividend paid at the end of the year. That is how much? 7 into, if they give a growth rate of 12%.
7 by 3.
7 point?
No, 2.33.
2.33. DP1.
No, DP1.
Answer, huh?
I am saying answer.
Okay, answer. Market price 0 is equal to how much, sir?
7 divided by 15 minus 12.
Okay, how much will come?
2.33.
Is it correct, sir?
No.
No, it should
No, sir. They should be 7 into
D0,
1 plus
D0
G.
has taken.
It should be 7 into 1 plus G divided by K
261.33.
Yeah.
So what is the answer?
So
261.33.
261.33, sir.
Correct. That should be the correct answer. Everyone. So what will happen? Don't jump into the answers of just like that. And formula, kindly understand the formulas and arrive the values. Okay. So CIPM model, I'll go back again to my, I don't know, I'm not doing justice to this topic. Why? Because...
Sir, you share this document also, sir, with us?
No, if I share out, I could not able to complete my presentation. That's my worry.
No, yeah, understood, but we can go through them after that.
Okay, definitely I'll share with you. Okay, anyhow, it's a part of the life. Then I'll go to this, at least I'll run through that my slides. At least that level I can able to help you. Okay, that's fine. So this thing able to see? No.
No, sir.
PPT? No.
No, sir.
Okay.
It's okay, sir.
Yes.
So kindly note down, if a company having a growth rate, there are significantly invariably two formulas that will be used. By using DDM method, DPS cost of equity is called dividend paid end of the year, market price plus growth model. And by using CAPM method, and expected rate of return is or cost of capital is nothing but risk-free rate plus beta into return from market minus risk-free. Return from market minus risk-free is nothing but the risk premium. This is the second model. And another model is the PE ratio model. These are also very important formula. PE ratio is nothing but MPS divided by EPS, and PE ratio is nothing but average. We can able to have it. And very, very important topic is WACC, weighted average cost of capital. So in examination, without WACC, there will be no question paper. So weighted average capital is nothing but by giving weightages of the capital structure with a levered, in the case of levered companies, what it could be the proportionate of equity with that cost of capital of cost of equity as well as the cost of debt. And by giving this formula, you can find out the WACC and NPV, RRR, everything, systematic risk, unsystematic risk you can study. And beta is nothing but a system value of amount portion which having a risk portion along with the compared to the market portion, what your company share portion risk is called the beta. And a beta formula in the case of in practical life, if you come to unlisted company, in case of listed company, valuation of listed company is easily find out from listed numbers. And but in the case of unlisted company, when you are doing a valuation for unlisted levered company, and if you have a data for an unlisted unlevered company, then how to convert from the data of unlevered to levered and levered to unlevered, by using this formula you can find out. And beta of the how to arrive the by using standard deviation, this the formula will be arrived. And three approaches we understood, and free cash flows we understood. Then free cash flows, then we can talk about FCFF and FCFP. As a holistically, if you know the cash flows by overall without having disclosed what the value you will get it for free cash flows form. If you reduce the free cash flows by debt portion and that debt area and capex and other working capital, why capex is removed? But total amount, if you could able to give it back to your owners, nothing going to be having in your hands, that is called capex. And enterprises value as a holistically, if you call FEFF, and we already studied this. So this is about this, how to arrive FEFF. I thought I can show you a few more things also. Okay, I don't know. 1 second. Yeah, I'll share you about this is the formula, scientific formula for FCFF, FEFE arriving it. So in examination, for example, if you have the P&L account restructured in such a way, sales minus, with this I'll conclude. If you restructure an examination, question will be not coming straightly. If you have to restructure your sales minus operational cost, you'll get EBITDA. If you reduce your depreciation, EBIT will come. After that, interest, if you reduce, profit before tax will come. For example, tax rate is 15%, PAT will come. And there will be working capital adjustments and there will be a capex adjustments. If you are restructuring from PAT, if examination gives restructuring from PAT, by using this formula, and you will arrive any point of stage, whether from the PAT, if you calculated, you will get the same FEFE, or if you calculated from the EBITDA, you'll get FEFE. And if you get from EBIT, you'll get it done. If you calculate from cash flow from operating activity, you'll get the thing. Practically, this thing can be worked out. And if you could able to understand this particular slide formula, even if you're not able to understand properly, this thing, other stuff, at least this formula, if you have a numbers from PAT, what is the formula to arrive this? And if you understand the logic sort of this, and you will get the same FEFE. From FEFE, you can reduce the cost and you can arrive the FEFEs. So this is the one which I thought I can share with you. So I thought if your time permits, I thought I can share with you some case questions of one second. You can able to see? You can able to see, sir? Word file?
No, only the PPT.
Okay, PPT, sir. Okay.
Now you are visible.
Yeah. So I thought some growth model, you'll get models like this.
Yes.
If it is a growth rate and CAPM model, 2-stage growth rate, if you've seen 1-stage growth rate, and you'll get FCFE, FFF, and you have case studies, how case studies question will be given, one case study will be, story will be given. Based on the case study, 4 questions or 3 questions, earlier 4 questions, 3 questions will be given, ABCD multiples are given, and you have to work out on that. This is how case studies will be there. If it is a theory, earlier case studies that will be asked, 2 models, numerical, theory, theory. So now we have a combination that definitely we have both numerical and theory. So examination is concerned, I had to speak a lot, but due to time or other reasons, 1 hour already exhausted. Only 3 minutes I'll take. 3 tips for examination is concerned. 1, please kindly book your examination irrespective of your preparation. Suggestion number 1, irrespective of your preparation, please book your slots down the line, week's time to 10 days. Immediately, once you book that examination slots, then only your preparation seriousness will come. So whether you prepared or not, automatically, if you book the slots, you are forcibly costly ticket of 1,500 rupees on GST. Definitely, you have to go that movie, good or bad, you'll go and see the movie. So kindly book the slot, number 1. Number 2, plan your preparation in such a format that entire syllabus you try to understand and do ABC analysis and do your ABC analysis based on the weightages and take some study material and which material you want to study, make your some mind fix and start your preparation, number 2. Number 3, once preparation is done, you try for the mark and number of MCQs which available in the market as well as your friends, close circle, faculties. And I thought a few more case studies also, question and answers around the 30-40 question and answers also I want to discuss with you because time constant, we could not able to do that. And yes, any other questions I can try to understand and answer open for 1 minute or 2 minutes. Any questions? Either it may be examination or related to what we discussed.
Sir, please share your notes, sir, as early as possible.
Sure.
Thank
Any
you.
question?
Your presentation is very nice for us. Like
nice,
it is,
nice, sir. Nice.
It is
I could not able to do
completely.
anything. I could not able to
No. Even in the short span, the short span, we are able to recall everything very quickly.
Great.
Yeah. Whatever you teach us now, it was very good, sir.
Thank you, sir.
Right. Because of time constraint, this problem. No problem.
No problem, sir. With some other time we can have it. No issues.
Thank you, Lord.
Thank you.
Thank you very much, Satyawada branch of SARS of ICI for giving this wonderful opportunity. So, as far as I'm concerned, definitely all of you taken a good decision for joining this wonderful profession, and you already come across your 50 hours of course. And now few people may already applied for the examination, attempted. So I hope from bottom of my heart that the immediate next attempt, all of you will clear it in the first attempt. No doubt about that. And if it's something wrong happen also, 2 possibilities. 1, you have to quit from the examination race, or you have to reappear. No one here to quit for the examination after spending all this money and time. Only thing is you have to reappear. Nothing to worry. You can reappear immediately. You will immediately you apply for 1 more time, and definitely you will clear out of your examination. So don't disappoint at any point of stage. And only solution for this examination to clear is my interaction with more than 400, 500 members of valuers all over India. I seen what I seen personally, interaction over phone or like classes in virtually or through class. My experience, only solution, only success rate for the passing this examination is please spend at least 50 hours at your home of your preparation. It is absolutely minimum required, and try to make your notes and simultaneously prepare whenever you are doing your preparation, and that will be helpful for your examination before the day and for your revision purpose. And number 3, and at the time of examination, only one tip is, as madam also given wonderful example as taken into, To pass the examination, there are two possibilities. You require 60%, not 60 marks. 60%. If you write for 60 marks, you will not clear because probability is remote. Is it possible to write 100 marks? Impractical, impossible. You will not clear. And is it possible to minimum 5 to 10 marks? You could not able to attempt. So not possible. So 90 questions may be attended, possible 90 to 95 questions. Out of that number of questions, if you attempt wrong, if you could able to minimize it, the possibility of passing will be more. So the probability is 75%, 75 marks to 85 marks to 90 marks if you could able to attend. I repeat, between 75 marks to 85 marks if you could able to attend, the probability for passing will be very high because minimum 10 questions, minimum, maximum, or else I put maximum 10 questions, you may write wrong also. Even then also there is a possibility to it. So 10 questions, if you leave also, there is no possibility. Those people are problematic, having problems in numericals. Don't worry, you can leave 10 questions also, no problem, relax, cool. And if those people are having a problem with theoretical concept, don't worry, 10 marks you can give it to the guard, no problem, you will clear it. So don't worry, your preparation, whatever you prepared, prepare nicely. And the expectation from the examiner will be conceptual understanding is very, very important. If you could able to get the concept understanding, perfectly all right. And prepare well and confidently go. And your 2 hours can be planned in the 4 slots. With this, I will close. First half an hour, whatever you know, you complete it. Whether which chronicle order you want to come, you can come. Minimum 45 marks you will clear. 100% guarantee. 45 marks, just like that in this stage, if you go also, you'll get 45 marks. Next half an hour, you spend on the case studies. Because last hours may you not get mind and you can't able to do it. So next half an hour you spend on case study or 45 minutes you spend on case studies. And remaining 45 minutes, second round, don't go for third round and too many things are not required. First impression is the best impression. If you could, you can at any part of stage, you can know how many questions you attempted, how many questions you are not attempted. And if you could able to confidently, pakka, you answer it. If you're not confident, don't do guessworking or your experience, kindly don't do it. And that will be negatively drop down your marks. So there are people 59, 59.25, 59.5, 59.75, 3-4 times I have students. So don't worry about that. Friends. So with this kind note, I wish every one of you in the participants all the very best for your next immediate examination. Every one of you will clear your examination in the next attempt itself. We pray God will catch you all. So thank you very much for this wonderful time.
Thank you, sir. Thank you very much for your excellent presentation of all the things.
Thank you, sir. Thank you.
Thank you very much for doing all those things. Now that I request, it is turned to the next speaker who is going to deal with the other case studies and other important information regarding this valuation course. And now I request our branch secretary Shita Shireen ma'am to read out the profile of BL Chakravarti sir. Shrita ma'am, are you there? Okay, let me do the
sir, only one request I have. With that I conclude. Sorry, if it possible, organization can create one WhatsApp group for this particular thing. So,
already created, sir. Already created.
If you kindly join me, kindly add me in the group,
sure,
so
sir.
that even yesterday's faculties also. So whatever material or MCQ or whatever suggestions are there, we can share with the members, sir.
Definitely, definitely.
Kindly add me. I will share all the information in the group. Thank you.
Sir, add all faculty, sir.
Sure, definitely. I'll add all faculty with their permission. I thought of adding everyone. Now
thank you very much.
They themselves are asked to, so we can add all the faculty members.
It will be very wonderful, sir. Thank you.
Thank you, sir. So nice of you.
Sir, that will be required for discussion, sir. Very useful. It will be very useful for exam point of view.
Sure, sir. Sure, ma'am. Definitely, it will be shared to you. One second. So coming to Chakravarti sir, Chakravarti sir basically is a chartered accountant and also is called Bihari Lal Chakravarti sir, and he is from Ghaziabad, and he is basically science graduate, BSc, and qualified as a chartered accountant, and also he has completed his CAIIB, and he is a CPA from ICFAI, and he has completed his FAFD course from Institute of Chartered Accountants of India and DSA from the Institute of Chartered Accountants of India, and he is an insolvency professional. He is a practicing the insolvency professional in the restructuring and insolvency for over 17 years. He has been providing a strategic advisory and consultancy services to the large number of industrial group on debt restructuring within and outside the CDR mechanism. And he is also a insolvency professional entity. Also, he's attached to the entity with Whitworth Insolvency Professional Private Limited. He has authored so many books, and he has been practicing income tax, banks matters, project reports, CMA data, and tax audit, and also as a specialist officer in the credit department, and also restructuring and insolvency and bankruptcy, general corporate advisory, M&A, and dispute resolution. And as I told you that he has written so many books. One of the book is been going to share to you all in the WhatsApp group. With this brief intro, I present B.L. Chakravarti sir to you all. Thank you, sir, and over to you. And Lord Krishna is behind you and really looking great, sir. Thank you.
Thank you, sir. Thank you very much. Am I audible to all of you?
Perfect, sir.
Yeah.
Sir, yes.
Thank you, Mr. Srinivas Rao and Vijayawada branch for giving me this opportunity to share my experience with all the esteemed professionals. I am from North, so maybe in my language you may hear a word of Hindi, but don't worry, just focus on the concept, what I am trying to share. I am sharing my screen. So,
sir, before that, a word from Chirmastan sir regarding Chakravarti sir, actually.
Okay. So first, my heartful thanks to Chakravarti sir for accepting this as a speaker in this group. We are very lucky enough. I want to express about Chakravarti sir. He wrote so many books about the insolvency and the valuation. I read this, especially insolvency books. He felt while writing the books, it's a non-commerce students. So he given that high priority to the fundamentals, high priority to how to basically you should understand. So that way he wrote both the books, the valuation as well as the insolvency. Recently I got this the valuation books also, 2 volumes. Then I'm trying to understand that is also is highly conceptual. It's not giving the full MCQs, but it's giving that conceptual understandings. Once if you read this the conceptual book, then we cannot face the doubts in the examination. So that's, I'm really thankful, sir. And that it's more useful even we are not a professional, we are not a chartered accountant, so can easily understand.
Yes, yes.
That is the behind of this book. So I'm really happy, sir. Thank you for participating, sir.
Thank you, sir.
We want to see you again. It's again in the more sessions and the different topics. Thank you, sir.
Thank you. Thank you very much.
Thank you, sir. Then, some of the
allow
members
me
are
to
asking
share
about where the books is available. That is
Sir,
also
it is available with
question.
me and it is
Kindly
available at
answer
Amazon
those
also.
questions.
So that we will discuss later. I don't want to waste participant time.
Over to you, sir. Thank you.
So allow me the share screen. I am unable to share. I am unable to share my screen.
Srinivas sir, please see that sir expressing is unable to share the screen.
I am unable to share my screen.
Hello.
Hello.
Just a minute,
Yes,
sir. I'm trying, sir. I'm trying.
Yes, please.
Now, please try, sir. Now you can try, sir.
I am unable.
सर एक बार रिफ्रेश करिए सर, you will be able to share. एक बार रिफ्रेश करके you can share.
Okay. So refresh. How to do refresh?
Right click. You have the options. इनमें एक ऑप्शन होगा रिफ्रेश.
Let me exit and re-enter.
Yeah, that's also a good idea, sir.
Sir, you make me a co-host and then quit, sir. Otherwise, it will be a problem. In the panel, in the panelist, you make me as G. Srinivasarao, make me a host, and then you can
okay,
re-enter. Otherwise, yes, sir. Thank you. And now that Chakravarti sir, now you can try first, sir. Now you can try, sir.
Sir, it's not happening.
Share screen.
Yes, I am doing
share screen button and entire screen.
Okay. Here you have changed settings. Only host can share the screen, no?
No, sir. No, sir. Co-host can also, because everybody is a co-host, sir. Hemant sir and Geeta ma'am is everybody co-host, sir.
Okay. Okay.
Sir, you opened that file and put it on the desk once.
I got it. I got it. The issues. I got it. The issue. Actually, I was trying to share all the screen.
Okay. Okay.
No, you have to open that sheet, sir.
No issue. I will draw. Okay. Now,
yes,
is it visible?
Yeah, visible, sir.
Yes, sir. Yes, sir.
Okay. So, you people has to come under the classroom model.
Fantastic.
Okay.
Yes, sir.
Thank you, sir.
Is it visible to all of you?
Yes.
Okay.
Yes, sir.
So, friends, whether you understand my language or not, I will try to explain from the basic concept. Okay. But I will say, just listen and understand the basic concepts. I will not run hurriedly. I will go slowly and slowly so that you know each and everything. So first of all, we should understand what are the concepts. We should understand present value, interest factor, present value, interest factor, annuity, net present value, IRR, profitability index. Then from cost of capital, we will understand KD, KE, KP, and WACC. Each and everything we will understand. From equity valuation perspective, we will understand PDM model, which Mr. Hemant was telling, and lot of case studies. Because you people should understand, until you have the case studies working in your hand, you can't do the practical problems. Okay. So I have developed this model and I am taking the classes in the same fashion so that कि आपको सारी चीजें clear हो. Clear है sir?
Clear, sir. Your language is also very clear, sir.
Okay. So now
I request everyone to
Yeah, you can.
in mode.
please mute yourself and I will ask you again and again. Don't worry. Okay. Now I would ask someone to read the question. Can you see this question?
Yes, sir.
Yes, sir.
These are the case studies which are regularly coming in the exam, regularly. And I am talking about recent case studies. We have more than 25-30 case studies which are regularly coming. Okay. So for solving these case studies, this case studies we are getting, this case studies we are getting, this case studies we are getting. Okay. So we have to understand and solve the case studies. For that, we need the basic concept. So I will not waste much time. I will quickly go on the basic concept. Now, do you know present value?
Yes, sir.
Yes, present value. How to calculate present value? 1 upon 1 plus percent. Yeah? To the power n. Now, what is present value interest factor? This is basically nothing but the table you get. We got the present value from table. Okay. So let me share. Okay. I am now, you can see this. You can see this.
Yes, sir. But only
अभी नहीं आया.
Heading, sir. Hello.
Can you see the word file?
Hello.
No, sir. नहीं.
This actually.
You are not opened the word file, sir. You just click it, sir.
No, I have opened. Let me.
No, it's not visible to us, sir.
Okay.
We are seeing a bunch of word files here, sir.
You are seeing bunch of word files.
Yes, sir.
एक बार ओपन होके बंद हो गया था सर.
Okay, चलिए कुछ करता हूँ. अभी ये I think some problem in share screen. I don't know what is happening. I am the host now.
Yes, sir.
Okay. Let me share.
Hello, sir.
अभी आया सर आया.
Can you see this?
Yes, sir.
अभी आ गया.
Okay, wait a minute. I will do from this also.
Right. No issue, sir.
Can you see? Can you see?
Maybe.
Yes. Chart आ गया.
Okay, chart आ गया ना? So this is basically future value, and this is
may go up to
starting for present value. Okay.
Yes.
So you must have gone through this chart in your basics exam.
Yes.
Okay.
Yes.
I'm just recalling, and I don't want to waste the time, so I'm just recalling. So this is present value interest factor, PVIF. Now, what is PVIFA? Can you see my screen now, or word file is only?
Only word file.
Okay, so some issues is there. Then I have to. Okay, so I have to do some more exercise.
नहीं आया सर आपका स्क्रीन आ गया.
नहीं वो I have to again share the note and word separately. because I want to share all the files, but it can't be possible. Maybe some issue. No issues, we will manage. Don't worry. Okay. So present value we calculate how if we are calculate for 10%, then we are.
Sir, 1 second, sir. Those files which you wanted to share, kindly paste it on the desktop and then open it, sir. Then it will be possible.
Okay. Okay.
You can try it, sir, during the course of the discussion.
Let me do because all people are expert. So
no, not expert, sir. Hit and trial. Recently, I faced this.
I have limited time, so I don't want to waste that time. I'm just giving you. This is my 5 years, and I am discounting at 10%. And value for first year will be 1 upon 1.1. That is 909. You may be aware about this formula, na?
Yes.
So 0.826.
Right, sir.
And 0.751.
7153.
0.683.
3.
620.
620.
621. Okay. Now I am writing here cash flow. Cash flow is 10,000. Clear?
Yes, sir. Yes.
So when the cash flow is uniform, instead of calculating the cash flow individually, we can calculate in a lump sum also. Like we can add all these figures. This will be 3.791. You can add this.
Yes, sir.
And this is 10,000. So there are two ways. One way is 10,000 into 9, 9090, 8260, 7510, 6830, 6210, 37910. Okay. Other way is 10,000 into 3.791. That is 37910. Okay.
Yes, sir.
Getting me?
Yes, sir.
Getting me?
Yes, sir. Yes, sir. Ara.
Concept clear hai?
Yes, sir. Clear.
Okay, now this is called PVIF. And this is called PVIFA. That is present value interest factor for annuity. So if the cash flow is similar, instead of calculating each and every cash flow, we can directly calculate by adding all the present value factors. So this is the concept of PVIF and PVIFA. Now in PVIFA, the cash flow should be
same.
So if there are different cash flows, apply PVIF. If the cash flows are same, apply PVIFA. Getting me?
Yes, sir. Yes.
Yes, sir. Yes, sir. Perfect.
Okay, great. Fantastic. Now the next concept is NPV. NPV is net present value. Clear? Is it clear?
Yes,
sir.
So now present value of cash inflows minus present value
of cash outflows.
Very good. Here. Now, how to calculate present value of cash inflows? There will be different cash flows. So you can calculate cash flows, multiply by your PVIF, you will get all cash inflows. And similarly, if the cash outflows in a different years, you can calculate the cash outflows also. Number 2, PI, profitability index. So profitability index is present values of cash inflows upon present value of cash outflow. So now, decision rule क्या होगा? What will be the decision rule? If net present value is positive, we should accept the project. And if net present value is negative, we should reject them. Now for PI, if PI is greater than or equal to 1, we should accept. If PI is less than 1, we should reject. Because if PI is less than 1, it means inflows is less than outflows. Clear? Now, third is IRR. It is very, very important concept because this concept is used in your bond valuation and in everywhere. So can you help me to find out how to calculate the IRR? Can anybody share the formula of IRR? Or what is IRR? My question will be, what is
internal
Where sigma NPV is
I'm
0.
not asking the full form of IRR. I am
It is where sigma NPV is 0.
Pardon?
Sigma NPV, sum of the cash flows and sum of the cash inflows and outflows is equal. At what rate it is equal, that is IRR.
Okay, great. So IRR is the discounting rate at which per PV is 0. That means present value of cash inflows is equal to present value of cash outflows. Am I correct?
Yes, sir.
Okay.
Yes, sir.
Now how to calculate?
अभी एक्सेल में फार्मूला आ गया है सर.
No, don't worry. I am just giving you some brainstorming how to calculate. So now, basically, this is called trial and error method because we don't know which rate, at which rate the NPV will be 0. So we calculate at lower rate where NPV should be positive and at higher rate where NPV should be negative. So we calculate discount at lower rate and at higher rate because 0 exists between these two. Agreed?
Right, sir.
So by interpolation method, we find out IRR. Getting me?
Right, sir.
Now I am taking some inflows. This is year 1, 2, 3, 4, 5. And this is cash flow 10,000, 20,000, 30,000, 40,000, 50,000. Okay. And my cash outflow is 1 lakh. Okay. Now I am calculating first at discounting rate 909, 10%. So 10%, this will be 909, 826, 751, 683, 621. Now quickly give me the values because I can't calculate each and everything. Give me the value.
$16,520.
Okay.
22,530.
Okay.
27,320.
Okay.
$31,050. Yes.
Total
is 1,08,510.
1,08,510. This is our present value of cash inflows. Cash outflow is 1 lakh. I have taken arbitrary figures. Okay. So net present value is
8510.
Okay.
Yes.
Now, just once we increase the discounting rate, net present value will go down. Right?
Yes.
So let's calculate the discounting at 2% higher.
12%.
12%. So this will be this is 893 797 71 636
6355
566
567.
So present value will be
8928.
15940.
Please.
15,940.
Okay.
So 21,353.
21,360.
30.
360. Huh.
Okay.
25,440.
Don't write this. I will share all these things. Don't worry. Just focus on the concept.
28,350.
28,350. Now, can you add this?
Roughly 1 lakh.
Roughly
1 lakh 30. 1 lakh 30.
Oh, so it
Almost.
means we need one more. That calculate at 14%. Okay. Basically, I thought it will be nearby 12, but I need to give the exact answer. So I am giving you. Okay. Now 14%.
Sir, 0.877.
0.877.
0.769.
0.769.
0.674.
75.
0.592.
0.592.
0.519.
0.519.
Sir. So the values are
15,380.
8770. Please.
15,389.
15,389. 80.
20250.
20250.
23680.
23680.
25950.
25950. So the value will be
94030.
94030. So this is our present value, and cash outflow is 1 lakh. So here plus 30 and here minus 575970. Okay.
Yes.
So this is our negative value and this is our positive value. So we will interpolate these two rates, 10% and 14%. At 10%, our net present value is positive. At 14%, our net present value is negative. So it means our IRR lies between these two rates. Okay. By luck, we already calculated it is coming nearby 12%. But let's see the formulas. Concept is clear.
Clear, sir.
Clear, sir.
Clear.
IRR lies between two rates. Okay. So since we have written the definition that IRR is the rate at which net present value is 0. What rate? How to calculate? So we calculate at lower rate where net present value is positive, higher rate where net present value is negative, and then interpolate. Now formula of IRR is wait a minute, I need to add more page. Okay, so IRR is lower rate plus present value of cash inflows at lower rate minus present value of cash outflow upon present value of cash inflows at lower rate minus present value of cash inflows at higher rate into higher rate minus lower rate. This is called interpolation. It clear?
Yes, sir. Yes.
Sir, yes, sir.
10% plus. What was the value of 108590? Okay, 108510. So 108510 minus 1 lakh upon 108510 और हायर रेट का क्या आया था? What was the cash inflows of 94030 into 14 minus 10. So can we calculate this? Percent plus 8510 24 upon 4480. So that comes
12.350.
350.
8, yes.
So this is our IRR. Now I am giving you some tricks. The narrow is the range. The best is the IRR. It means if you increase, if you calculate at 11% and 13%, it will be different from the existing. We have calculated 12% and 14%. It is coming 12.35%. It may come 12.10%. Or if you calculate the range is less, the more accurate IRR you get. Getting me?
Okay, yes.
So now this is from practical perspective. I am giving you one more derivation from this IRR. Okay. From this formula, we can calculate one more IRR, one more formula. Lower rate plus. Okay, we need some more page. So let me insert more page. We have given IRR is equal to lower rate plus present value of cash inflows minus present value of cash outflows upon present value of cash inflows at lower rate minus present value of cash inflows at high rate, high minus low. Yes? Yes? This formula I have given?
Yes, sir. Yes. Yes.
Okay, now I am doing some little changes in the formula. Lower rate plus. This is our NPV. Net present value at lower rate. Yes or no?
Yes, sir. Yes, sir. Correct.
Now this is present value of cash inflows at lower rate minus present value of cash outflow minus present value of cash inflows at higher rate minus present value of cash outflow. You understand? Minus minus plus, this will cancel with this.
Okay.
This is minus and this minus minus plus, so this will cancel with this. Like
Yes,
this.
sir.
Into high minus low. So this is another formula. If you have net present value, then also you can calculate the IR.
Excellent, sir.
So please note this. These are the key
Excellent.
notes I would ask you to know. Please note this.
Yes, sir. Noted.
Excellent, sir. Arriving based on NPV itself, IRR we are arriving. Great notes.
In some cases, they provide you entry.
You never thought about it.
Then, how to calculate the IRR? It is very simple.
True.
So, can I move ahead?
Yes, sir. Yes, sir.
Okay. My target is to do some case studies, But for that, I have to give you the basic concept. Without basic concept, I can't move ahead. Okay. So now I'm giving you this concept, and now I am taking you to the cost of capital concept. Now, what is cost of capital? Can you give some explanation?
Cost to the company, cost to the fundraising.
Cost of company is not a correct word, but the capital is the company has invested. What is the cost the company is bearing on that? So capital consists three parts like equity share capital, preference share capital, and debts. Okay. So for each, this is called cost of equity. This is cost of preference share capital, and this is called cost of debts. Okay. It represents by KE, it represents by KP, it represents by KD. And for the overall, this is called KO, overall cost of capital. This is called weighted average
cost of capital.
Cost of capital. Or you can say overall cost of capital. So now I have to understand the concept of how to calculate KD, KE, KP, and KO. Okay. One case study is frequently asking from this concept. So let's understand the concept of KD first. KD is cost of debts. So now there are two things. One, debt is redeemable, and another thing is debt is irredeemable. Is it clear? Redeemable and irredeemable?
Yes.
Redeemable, yes. You know, KD is interest 1 minus tax upon net proceeds. Net proceeds means whatever the money you have received on issuing the debts, or market price you can mention. For the redeemable debts, there are a redemption value. So now if there is a difference between the issue price and redemption value, then the extra amount which you have to pay need to be amortized over the period of time. So KD is equal to I 1 minus T plus be attentive, redemption value minus net proceed upon number of years. These are the number of years after that you have to pay. So basically this is nothing but you are amortizing the cost which you have to pay after 5 years, after 10 years, upon RV plus NP divided by 2. This is nothing but the averaging the amount, redemption value which you have to pay. So this cost is applied on the average amount. So this is the formula for redeemable debts, and this is the formula for irredeemable debts. Is it clear?
Yes, sir. Yes, sir. Yes, sir.
Wherever you found some difficulties, please, because I am not very much fast, but I am a very slow, and you understand the tortoise. So I am a tortoise type people. Now,
okay.
KP is the cost of preference capital. So here also irredeemable and redeemable. Now, if redeemable, KP is equal to preference dividend upon net proceeds, and redeemable is KP is equal to preference dividend plus it is quite similar with that redeemable debts. Clear?
Yes, sir. Yes.
Okay, great. So you people are very attentive. I am happy to listen this. Now, this is cost of equity, KE. It's very, very important because here I am using KE, but this will come again and again in your problems. So there are 4 methods of KE. One is dividend approach. Second is earning approach. Third is realized yield approach. And fourth is CAPM. These 2 methods are not useful for our course. So we need only these first and fourth method. But I am telling you so that you should understand what is the purpose. Now in dividend approach, there are 2. Without growth, K is equal to dividend upon P0. With growth, K is equal to D1 upon P0 plus G. Now, what is the difference between D and D1? D1 is expected.
Expected, yes.
Expect next year पे जो dividend मिलने वाला है, that is D0 1 plus G. Now, please understand, sometimes they mention expected dividend itself. So in that case, you don't have to add growth. Sometimes they mentioned as last year dividend was this, then you have to add growth percentage. Okay? Okay?
Yes.
Now in CAPM, KE is RF plus beta, RM minus RM. RM is return on market portfolio. RF is risk-free return. And beta is, it will be given in normally all the questions, beta factors. Okay. So I would request, please note down this. This is very important.
Yes, sir. Noted.
Please note down this.
Noted.
Okay. Now, can I drive one more thing?
Yes.
Now, G is equal to G is the growth. I am not calculating formula for this. I just mentioned G is equal to B into R. Okay.
Okay.
B is retention ratio. Retention means earning retention ratio. That is 1 minus DP.
Right.
1 minus DP. And R is return. When it will be mentioned return on equity, it will be mentioned. So G is equal to B into R. Sometime I have seen one question, recent case studies, where this concept has been used. Now, can I use this formula. Okay, we have mentioned K is equal to P1 upon P0 plus G. So can't we calculate P0 from here?
Yes.
Yes, we can do like this.
We can calculate now.
Yes.
Yes, sir.
Now, once the growth is constant, we can apply this formula. But I mentioned when the growth is constant. So until the growth is constant, you have to do some other way. I will tell you. Don't worry. So is this concept is clear?
Clear, sir.
Yes, sir.
So let me go on the next page. Now we have to find out now WSCC. Okay. So WSCC, you have to mention equity, share capital, preference share capital, debts. Normally it is given that debenture percentage, it is given in the question normally. So you don't have to worry. I'm just considering the amount. It is 40 lakh. It is 10 lakh. And it is 30 lakhs. Okay. I'm just taking the amount. KE is 15%. KP is 12%. Tax is 30%. So KD will be
7%.
very good. How? 10%, 1 minus 30%. Okay. Now you have to calculate the proportion. Proportion is this. This is 80 lakhs. So how much will be? This will be 37.12% and this will be 12.5%. Getting me? Proportion of capital. How much amount you have in equity share capital? How much amount in preference share capital and how much debt? Okay? Okay?
Yes, sir. Yes.
So now WACC is 15% into 50%, that is 7.5%. 12% into 12.5%, just calculate this, and 7% into 37.5%, just calculate this. This is 1.5%.
1.5%.
And this is 2.625%.
Yes.
So now this is WACC. Okay? Okay?
Yes, sir. Yes, yes.
One more way, this is frequently used. Frequently used method is this. One more way, we can calculate the amount. 40 lakh into 15% is 6 lakhs. This is 1,20,000 and this is 2,10,000. So how much? 9,30,000. So a WACC is 9,30,000 divided by 80 lakh, 11.625%. But normally we use this. Normally we use this. Okay. So formula for WACC is
Sir, 60 lakhs कैसा आएगा?
6 lakh, 6 lakh. 40 lakh, 15%.
Sir?
40 lakh.
40 lakhs into 15%.
Okay. Right.
This is the cost, amount of cost. Okay.
Okay, sir.
So now KE, KD into debt upon debt plus equity plus KE into equity upon debt plus equity. This is the formula which we normally use for calculating the WACC. Hello.
Yes, sir. Bolo.
So is this concept is clear?
Yes, sir. Perfect, sir.
थोड़ा practice करना पड़ेगा.
No, tell me the
Fine, sir. Fine, sir.
You just tell me the confusion where you are getting confused.
Confusing
Perfect,
not there,
sir.
but practice required.
Practice definitely. If you have to go to the exam, then you need to do practice.
Yes, yes.
But I am asking you the confusion. Whether any confusion is there?
No confusion, sir.
No confusion, sir.
There are some chats are coming. I am unable to. I am not focusing on the chat. So you people has to speak on the mic only. Okay. Now, so I have given you the concept of PBIF, PBIFA, NPV, profitability index, IRR, KD, KE, KP, WACC. Okay.
Yes, yes, sir.
Now, let me do some questions. This is the question which you people has to do. Yeah. Is it visible?
Yes, sir. Visible, sir. Yes,
थोड़ा zoom कर दो sir उसको.
This facility is not available on my.
अच्छा,
Let
okay.
me try. Let me try. Let me try.
नहीं.
Let me try. Let me try.
हाँ, वहाँ
Yes.
sir. हाँ, right.
Yes.
Yes.
Is it visible now?
Yes, sir.
Yes, sir.
Okay, great. Now, this is the question. I have just given you the concept of WACC. Now, this is the case study, and this is not the dummy case study. This is the question which has been recently asked in the exam. Okay, you have to just read the question because we have not time. We allow you to do the question. You have to read the question. Now you people also start taking lunch because we may take a long session if all of you permit. But I can assure you that after this session, you will not be facing problem in case studies and practical parts. Okay, have you read the questions?
Yes, sir. Yes, sir.
Okay, now I am doing this question. N Limited has the following capital structure: equity share capital, preference share capital, and debentures. The market price is 20. Market price is 20. Read this. It is expected. I have told you expected dividend. So D1 is given. D1 is 2 rupees. And it will grow at the rate of 7%. So G is 7%. And P0 is 20. Can we calculate KE? Can we calculate this?
17%, sir.
Great. Now we have to calculate the WACC. How to calculate? Equity share capital, preference share capital, debts. Preference share capital is 6%, debt is 8%. So amount is 40, 10, 30. KE is 17%, 6%, and tax is how much? 50%. So this will be 4%. Proportion, what will be the proportion? 50%, 12.5%, and
सेम पहले का
37.5%.
37.5.
Can you calculate the WACC?
Yes, sir.
This 8.5%, 0.75, and this is
10.75.
1.50.
1.5.
So 10.75. How much time you took?
Yes, sir. Easy.
How much time you take? In 2 minutes?
Yes, sir. 2 minutes.
Because the concept is there. You can calculate any question in 2 minutes itself. Now, the new weighted average cost of capital, if the company raises additional debt, it means now new debt has been there. So, how to calculate equity capital, preference capital? 8% debt is there now. Additional debt is 10%. Amount will be 40, 10, 30, 20. This will be how much? 100.
Yes.
Now, cost is 17%, 6%, 4%, and 10%.
5.
Great. Proportion is 40%, 10%, 30%, 20%. This will be
3.4.
6.8%, 0.6%, 1.2%, 1%. Can you add all these?
Yes.
17 4 the 6 10 the 4 3 the
9.6.
9.6. Some wrong calculation I have done. What wrong I have done?
To calculate KE again.
Pardon?
We need to calculate KE again, sir. Cost of equity.
Yes. They have mentioned that the dividend will be 3 and the price will be 15. So our K is wrong. Okay?
Yes.
So you have to understand, it's not like that earlier KE will work here.
Yes, yes.
So now KE is 3 upon 15 plus 7%. That will be 27%. Am I correct?
Yes, sir.
Now, if it is 27%, then it will be how much?
13.8%.
10.8%, and that will be 13.6%. You got me?
Yes, sir. Yes, sir.
Now, third, here they have increased the growth rate. So now KE again change. Now KE again change. In this case, KE will be 3 upon 15% plus 10%. That is 30%. Okay?
14.8.
Okay?
Yes, sir.
So for third, our answer will be KE is 30%. This is 6%. This is 4%. This is 5%. Now WACC will be 30 into 40, 12%, 0.6%, 1.2%, 1%. How much? %14.8%. Seems very simple now.
Yes, sir. Yes, easy.
So this types of question IBBI is asking, and we are saying, oh my God, I don't understand what questions IBBI has asked. No issues. I will try to. This is the case studies is available in my books. I have already given you more than 10 cases, 21, 25 case studies. Okay, so let us do this question. Let's do this question.
Secretary, sir, we have a time up to 8:30.
Sir, I can set up to 12 o'clock if the participant allowed.
No, the participants are ready.
थोड़ा रुको ना, 15
Beyond
मिनट मेरा क्लास
8:30
चल रहा।
also.
So we are ready,
हाँ,
sir.
मैं फोन करूँ ना तो आप लोग 15 मिनट से करो बेटा, ठीक है?
If the participant permit, I can take the session because I know the importance of this session.
Yes, yes.
I told you, Mr. Tana, that I would be requiring more 8 to 10 hours, but when I see your pamphlet, then I understand it is quite.
हाँ? ये चल रही है क्यों बोलना?
Okay. So now this is the question of IBBI first model test. Okay. And this is the basic concept for equity valuation, which Mr. A.V. Geeta and Mr. Hammond has already told you for the dividend discount model. So we will take this case studies and we will develop our concept. I would request all the participants just to read the question carefully. So have you read?
Yes, sir.
Okay, now I am reading. Mr. Dev, our research, I have done this method. First, I try to give you the opportunity to read because your mind is raw. If I read first, then you may not develop that things also. Okay. Now I am reading. Mr. Dev is a research analyst, has been hired to value RC Limited, a company that is currently experiencing rapid growth and expansion. Dev is an expert in the communication industry and has had extensive experience in valuing similar firms. He is convinced that a value for the equity can be reliably obtained through the use of three-stage free cash flow to equity model. Three-stage. It means the growth is varied. In one stage, some growth is there. In second stage, some growth is there. And after there, some constant growth is there. With declining growth in the second phase, based on up-to-date information, he is determined that current FE per share is ₹1. He has prepared the forecast of expected growth. So now there are three growth. First, 8% for 3 years. Second, 7% from 4 years. 6.5% 5th year. 6% 6th year. After that, this is constant. Okay. I have already told you the formula for constant growth. P0 is equal to D1 upon KE minus G. I have already told.
Yes, sir.
So, but this formula will come in which year? After 6th year. Because 6th year dividends growth is different. After 6th year, this will be the price. Okay.
Sure, sir. Continue, please.
Okay. Now, Dev has determined that company beta is this, risk-free is this, equity risk premium is this, other financial information is this. From this, we can calculate KE. Which method? CAPM method. RF plus beta, RM minus RF. That is how much? 3% plus 1.6, 5%. That comes to 11%. Am I correct?
Yes.
Simple or complicated?
Simple है, simple है.
So the first answer is there. Now for second answer and third answer, we have to do some calculation work, which I will do. Okay? Okay. So before going that, first of all, let's understand the concept of FCFE and FCFF. Can you tell me what is FCFE?
So cash flows available to the equity holders and cash flows available to the firm.
Very good. Now, can you tell me how to calculate FCFE and FCFF?
So like, so based on the EBITDA, sir, from the EBITDA.
Okay, so that's the reason, because I have already told you in my initial session, we need to develop the concept.
Yes.
Now, FCFE, that is free cash flow to equity. How to calculate? There will be EBIT. You have to mention I. Then it will be EBT minus T. This will be EAT. And you will get CFAT minus CapEx minus delta of working capital. You will get FCF.
Perfect, perfect.
Getting me?
Right, sir, right, sir.
Now, FCFF is equal to FCFE. Now, what is the difference? This is the firm. So, firm means it is the capital employed. Okay. And this is only for equity. So, if you add the interest net of tax, you will get FCFF. Getting me?
Yes, shortcut method.
FCFE is equal to this and FCFF is equal to this. Now, if you are calculating the value of firm, then use FCFF. If you are calculating the value of equity, then use FCFE. Okay?
Yes.
So now when calculating the firm, you will use FCFF upon WACC minus G. And when you calculating the equity, then FCFE upon KE minus G.
Minus G. Right.
Have you got the variation?
Yes.
Yes, sir. Yes, sir.
When we have to use WACC and when we have to use KE.
Yes, sir.
Yes.
When
Am I
FCF.
able to resolve your doubts?
Clear, sir. Clear.
Okay,
very
great.
clear, sir.
Okay, great. My objective is achieved and I am able to contribute a little bit. Okay. So now our question is there. I have already given you this Mr. Dev case studies that I have to solve. Okay. So let's start. There are the FCFE. How much FCFE is there? Current FCFE, 1 rupees per share.
1 rupee, sir.
Okay. And per share, how much? 100 lakh. 100 lakh. Okay. That's not a thing. We can calculate from 1 rupees only.
सर आपकी आवाज क्लियर नहीं आ रही.
My voice is not clear?
हाँ अभी
Sometimes network issue. I am
Yes.
speaking, don't worry.
Yes, yes.
Okay. So now we have to calculate the growth. This is FCFE. This is 1 rupees. From 1 to 3 years, how much growth is there?
6%.
6%. After it is how much? 7%, 6.5%, 6%, and then 4%. Am I correct?
Yes, sir.
So this will be how much? 1.08. This will be how much? 1.08. But 8%, 1.08.
Right, sir.
Please speak. Until you speak, I will not go further.
Okay,
Yes,
sir.
sir. Yes, sir.
1.16, 1.259, 1.34, 1.43, 1.52, 1.58.
And here will be 1.5825. Okay?
Yes, sir.
This is our what is expected. I told you na?
Yes.
Yes, sir.
Now, here, since growth is constant, we will use P0 is equal to B1 upon KE minus G.
Yes, sir.
So here B1 is 1.5825. KE is how much? 11% and G is 4%.
4%.
This value comes how much?
Two point 220.
2 point?
No,
Oh,
No, 22.60. No?
22.60. sir.
this is called terminal value. This is the price of the share or price of the equity after the 6th year. Am I getting?
Right, sir.
Yes. Yes.
After 6th year. Why we have calculated in this way? Because up to 6th year, there are variable growth. So we can calculate the terminal value only once the constant growth is there.
Right, sir.
Okay?
Yes, sir.
Now, PV factor we have to calculate at 11%. That is our KE. Okay? Because we are using equity FCFE. I told you.
Yes.
If it is FCFF, then it will be QAC. Okay?
Yes.
So at 0, this will be 0. This will be 9009. Just give me the values.
So 0.811, sir.
How much?
0.593,
11%.
0.593, 0.534.
Okay. Now please listen. Here, maximum people doing error. They are further discounting this. No,
Exactly, sir.
we do not have to discount further because this is not 7th year.
At the end
This
of
value at the end of the 6th year.
Okay.
So you have to calculate terminal value at the discounting rate of 6th year or the last year. Once the growth is there, constant growth is there, we have calculated the cumulative value of all the dividends or all the free cash flows at 6th year end. Getting me?
Yes, sir. Sir, yes.
I am explaining again. Up to 6th year, there are variable growth. So the concept is that you have to calculate the cash flows of various year on a growth basis. Once the constant growth is there, you calculate the terminal value.
Okay.
Terminal value will be calculated once the constant growth is there. Okay?
sir.
Now,
Yes.
present value, I'm just writing, it's 0.9730, it's 0.9467, 0.9211, 0.8879, 0.8519, 0.8135, and this will be how much? 12. Okay. Okay.
Yes.
Now, this is called terminal value and this is called present value of terminal. Okay.
Yes.
And the sum total of this, please do the sum total.
5.39. Oh, okay. 12 points.
This is your value of equity share. What you did? You have calculated the growth of different years. Once the constant growth is there, you calculate the terminal value. And then of all the values, you apply the present value factor and calculate the value at the 0 period. So now 70.48 is the value of equity shares at today's period.
Yes.
Okay?
Okay, so 17.48.
Concept is clear?
Yes.
Clear, sir.
Okay. So now let's read the question. The terminal value in year 6 is closest to how much? A. Am I clear? Am I clear?
Yes, sir. Yes, sir.
Clear, sir, clear.
The per share value they should assign to RC Limited is closest to how much?
17.35. Yes.
And the last question is the free cash flow to the firm is closest to. Now that we can calculate. For this, they are asking what? Free cash flow to the firm. We can calculate free cash flow, equity plus interest, 1 minus tax. Yes or no?
Yes, sir. Yes. Yes.
Okay. Now I have already told you free cash flow is 1 rupees per share into 100 lakhs share. That is 100 lakhs. And I is given, it is given in the question 30 lakh rupees. This is given. Okay.
Yes.
I is 30 lakh into 1 minus 40%.
40%.
18 lakh.
18 lakhs. So
this is 100 plus 30, 1 minus 40%. That is 180. Option is C.
Yes.
Now tell me seriously, have you able to digest this case study?
yes, sir.
Yes, sir.
Yes, sir.
थोड़ा प्रैक्टिस करना पड़ेगा बस.
So, very lucid manner you explained, sir.
I am just asking you the concept.
Yes, yes.
Have you able to digest the concept? Or
Yes,
Yes, sir.
It
Yes,
is going up.
No, sir. No,
No,
sir.
no, sir.
Get it.
Perfectly reaching, sir. Perfectly reaching.
आ रहा sir.
I am not teaching through PowerPoint presentation.
Yes.
I didn't get the component. I have the PPTs, but until I interact with the participants.
Yes.
Sir, perfectly you are injecting, sir. Injecting into our brain. Straight away.
I am trying to inject basically. So this is the case study. Actually, this is a case study of first sample paper, and it has came many times in the exam, approximately 10 to 15 times, because earlier the case studies were less. Okay, now
Yes,
it is
yes.
bundle of case studies. Now do some questions. I have already given you the concept of WAC. This is the case studies. People are behind my life. Why you are not solving the case studies? Why you are not solving the case studies? So I have solved this also. It was asked again and again. If some of the participant has gone through the exams earlier, they can write that these case studies are coming in the exams. Hello?
Sir. Sir.
Okay, so let's do this case studies. This is case studies based on WAC, WP. Okay, so basically here it is given equity share capital 2 lakh share. It means 20 rupees per share. Okay.
Okay, sir.
This is 10 lakh. This is 30 lakhs. If you see the case studies which we have already calculated, it is the same case study. We have just done the case study just now.
Yes, sir.
Case studies. Here the question is given in a different form. Here the question is given in a different form.
Right, sir.
Yes.
Here you can see, here our KE came 17%. Here
Here
our
also,
KE came 27%. Here KE came 30%. Am I correct?
Yes.
So this is the case studies. I don't think so. We should do this. Let's jump and do some other question. Okay. I am doing those case studies. It has been recently asked. Okay. So let's do this case studies. It is not solved earlier also. So let's do with you.
Amazon company, a leading manufacturer of
Okay, Ramesh & Company is a leading manufacturer of healthcare products and the return on equity in 1992, 31.4%. Payout is 30%. It earned a net income of 1625 million. And a book value is this. As a consequence of healthcare reform, it is expected that the return on equity will drop to 25% in 1993 and that the dividend payout ratio will remain unchanged. It means it will be 36%. Okay. Now, existing growth rate is in earning. I have already told you growth is B into R. B is retention ratio.
Retention ratio.
That is GP.
Earlier question screen is visible, sir.
Pardon?
Earlier question screen is visible. This question screen is not.
I can't hear you, dear. I can't hear you. Okay. This is 1 minus 36%. That will be 64%.
Earlier question screen is visible, sir. The case study is 0 PQR. That is visible.
This case study is not visible?
No, sir. No. Anybody else can
Visible, sir. Case study 6 is visible.
Visible, sir.
Visible, sir. Very clearly visible. Case study 6 is visible.
Some people says raise hand.
No, sir. It's visible, sir.
No. Actually, some people has raised hand. What are the issue basically?
No, by mistake can happen, sir.
Yeah,
You please carry on.
Murthy, Naresh Sharma. Okay. Abhi sabke gaye. Okay, no issue. So this I have given you the concept. G is equal to V into R. Yes or no?
Yes, sir.
Now R is how much? So G is equal to 64% into R was 31.4%. Naresh Sharma, just mute yourself and speak.
20.1%.
What else you are asking from IBBI? Without giving you the question, they pass all of it. They are asking simple questions, but until you have the concept, you can't do the questions. Agreed?
Right, right.
No.
नहीं अभी क्यों थका हुआ?
सीधे से क्लास कर रहे हैं। हुई नहीं क्लास?
No.
नाम मेरा आया ही नहीं ना।
Hello, someone please mute.
They are going to send us sorry, dinner. Now, second question is estimated growth in 1993. Here is some mistake. It should not be growth rate. It should be growth. Okay. Estimated growth in 1993. This is technical, so please understand this. In 1993, you have opening equity. How much? 1992, 5171. Yes? Yes?
Yes, sir.
Yes, sir. Yes, sir.
Okay.
Yes, sir.
You have income, net income of 1625. And you have dividend payout ratio, how much?
36%.
That is 1625.
585.
36%, that is 585. So what will be the equity for 1993?
6211.
6211. Now, in 1993, return on equity is 25%. That is 6211 into 25%. That will be how much?
1552.75.
52.75. Okay. And return in 1992, how much? 16.25. So change is 1625 minus 1552.75. That is minus 52.25. So growth
4.45 minus
93 minus 72.25 upon 1625. That comes to 4.45%.
4.45.
minus 4.45.
Okay, maximum people has wrongly attempted this. Maximum people, I am talking about more than 90% until we have solved this.
Okay.
Because they are telling that both the question are same. But here they are asking estimated growth and here is growth rate. Once the growth rate is there, you know the formula B is B into R. So B is how much? 64% and R is how much? 25%. Yes or no?
Yes, sir.
Yes, sir. 16%.
16%. B.
So this is 6 marks case study. But if you know the concept, you can do. If you don't know the concept, you will be facing problems. Kapita, how much time I have? Should I take further?
It's absolutely participant choice, sir.
Yes, sir.
Yes, sir. Please, please.
Yeah, Ritesh also
Ritesh
is
ji bhi
there.
Okay, let's do this question also. This question has been asked many times. So let's do this question also. This is from the bond valuation. Actually, I have oceans of questions. I can take for 2 hour, 5 hour, 10 hour, 1 day, 2 day, in practical aspects only. So, but that will be too much. Let's do this question also. And we'll try to cover up some concept also. And then we will conclude. Okay.
Sure, sir.
Okay. This is a case study. In the recent exam, we have seen these questions, and recent mock test sample paper, we have seen this question. The question is very simple, but you have to attempt with conceptual manner. Let's read it. Based on the credit rating of bond, Mr. Sukram has decided to apply for the following discount rate for valuing the bond. This is the following discount rate. That is for discounting purpose. Please understand, for discounting purpose. Okay. He is considering to invest in AA rated bond. Now T-bill rate kya? How much? T-bill rate is 9%. So AAA rate will be 9% plus 3%. That is 12%. AA rate will be 12% plus 2%. That is 14%. And A rated is 12% plus 3%. That is 15%. So which rate we have to apply? Which rate we have to apply?
14%.
Why? Because he is interested to invest in AA. Yes?
Yes, sir.
Now this is the currently selling price. It means this will be the cash outflow which you have to pay.
Yes, sir.
You have to pay.
Yes, sir.
Agreed? The bond has 5 years to maturity. It means the investor will get interest for 5 years. Okay? The rate of interest is 15%. Okay? Now, I have been asked what is the intrinsic value of the bond. So now intrinsic value is nothing but the present value of all inflows. So let's calculate the all inflows first. This is year. This is inflows. 1, 2, 3, 4, 5, 5. Here you will get 150, 150, 150, 150, 150, and here
150, 1,000, 1,000 plus 150.
Any doubt? Any doubt?
No, sir. Clear.
Okay. Now discounting rate is how much? 14%. Yes?
14%, sir. 14%.
So 14% calculation, you have to give me the discounting factor 1 divided by 1.14. That comes to 0.877,
0.877,
0.769,
69,
0.674,
0.592,
0.592.
0.519.
Have you seen? These are same.
Right.
Yes, we can do
So
in
we
short.
can apply PVIFA.
Yes, short tour.
And this is 519. So the sum total of this is how much?
3.4. 3.433.
3.433.
Yes, sir.
This is our PVIFA for 14% 5 years. Yes or no?
Yes, sir.
Okay. Now, so intrinsic value will be 150 into 3.433 plus 1000 into 0.519. Yes?
Yes, sir.
Can you tell me?
$1,034, sir. 1,034.33.
into 514.3595. So that is 1033.95. So it is near to this. I have rounded off to 3 digits. Maybe possible that they have calculated in a way. So the intrinsic value comes to how much? 034 point. Now, second thing, is it a desirable investment?
Yes.
Yes. Why? You are getting 15% and your cost is 14%. Yes or no?
Yes, sir.
Another point of present intrinsic value is 1034.23 and your outflow is 1025.86. It means you are getting positive net.
Positive.
Positive, sir.
Still, it is a desirable investment. Okay. Now, another thing is the yield till maturity. Yield till maturity is nothing but the IRR. Okay. Okay.
Okay, sir.
So now we know the net present value at 14% is how much? 1034.23 minus 1025.86. That comes to 8.37. So for IRR, we need one positive value and one negative value.
Correct, sir.
Yeah.
Right,
So let's calculate net present value at 15%. That will be 15 into PVIFA 15% 5 years plus 1000 into PVIF 1550. Am I correct?
Right, sir.
So let me give you the values. It's 3.3352. Three 352. 352 plus 1000 into 497. Can you give me the figures?
Exact thousand, sir.
50 into 3.352. That is 2.8 plus 497.
997.
That's 997. 999.8. Okay. Okay.
Okay.
So let's do at 14%, at 15%. Present value of cash inflows is 1033.95 and 999.80. Present value of cash outflow is 1025 point, how much? 1025.86. It says 1025.86. Here the value is minus 26.06 and here $8.09. This is plus, this is minus. So yield till maturity is equal to lower rate plus 1033.95, or we can apply the NPV also, na? 8.09 upon 8.09 minus 26.06 into 15 minus 14. This comes to that comes to 14.24%. Here is the answer. Okay.
Okay.
So what is yield till maturity? Yield till maturity is nothing but the IRR of the bond. There are another formula of YTM, that is yield till maturity. Okay, let's forget it, else you will get confused. And what is the current yield? Current yield we are getting at 15%. Yes?
Yes, sir.
Yes, sir.
So I think so. I have taken you through all the concepts. Let me revise in a very quick manner, and then we will conclude it. Okay?
Yes, sir.
Because you understand the time is very limited. I have given you the concept of
PVIF.
PVIF. Yes. Okay. Yes, I have given you the concept of PVIF, PVIFA, then the NPV, PI, IRR.
Yes.
Then I have told you how to calculate the IRR. Then I have given you the formula of IRR. Okay. Then we derive this. Then cost of capital we understand. KP, cost of equity. I have told you that this is the formula of KE. Okay. When the growth is there. From this we have find out this formula also, where terminal value we calculate. Okay. And we have also understand the growth formula. Then this WACC we have calculated. Then this case studies was similar. We have calculated the case studies. Here we have basically given that there are 3 stages growth. So what we have done, we have calculated the growth of all 6 years. Once the constant growth is there, we calculate the terminal value and apply the present value factor. Okay.
Yes, sir.
And we have calculated this case studies on back. You people have calculated. We have this was their case study. Can we do this case study also?
Yes, sir.
Okay, I will do. So we calculated this case study also, and we have calculated this case studies also. There are 2 case studies which is pending. If you people are allow me, then I can do this.
Yes, sir. Please.
आप लोगों को भूख तो नहीं लग रही है?
नहीं सर, बीच में खा लेते गए हम लोग.
Very good, very good.
ऐसे कुछ नहीं सर. Sir, ऐसे कुछ नहीं. We didn't go for toilet also, sir. Literally speaking.
That's the spirit. Ideally. Okay, now.
Full, sir.
Okay, now, friends, I have to told you that in this question the options are not correct, because I am calculating the NPV, but the NPV is not coming in these values. But I am giving you the solution how to calculate the question. Okay. Maybe some presumption is there, which I don't know what is the issue, or maybe the person who has mentioned this question, maybe he has mentioned something wrong. So once you people have seen these questions in your exam, just note it down the correct values, please. Okay. Now, this is the question from Capital Busting. Here they have asked what is the NPV of the project. Now NPV, how we calculate?
Present value
of cash inflows minus
Present value of cash
Cash
outflows.
outflows. Am I correct? Project
Yes.
life is 5 years. So first of all, we have to calculate cash flow after tax. How we can calculate cash flow after tax? We have sales. Sales is how much? 2000 into 30. We have variable cost 2000 into 10. So this is 60,000 and this is 20,000. 40,000 basically will be our contribution. Fixed cost we have 10,000 and now depreciation is there. So depreciation we can calculate on a straight line method. So depreciation comes to 8,000. How? 60 minus 20 upon 5. Yes? It is given. Okay? So, cash flow, sorry, profit before tax is 22,000.
Tax.
Tax is 40%. That will be 8,800. The profit after tax will be 13,200. Depreciation we will add how much? 8,000. So CFAT is 22,200.
Yes.
Yep. Okay.
Yes. Cash flows.
Now, present value of cash inflows will be how much? CFAT into PVIFA, 14%, 5 years. Am I correct or not?
Yes.
Plus
I need to practice.
10,000 into PVIF, 14%, 5
years.
Plus 20,000 that and recovery from the fixed assets, PVIF, 14% into 5. Okay. So that will be 21,200. We have just recently calculated. It was 3.433. 10,000 into 0.519 plus 20,000 into 0.519. Yes? Just give me the values. How much? In my calculation, it comes to
88,362 are sir. Okay.
88,349.6. Am I correct?
Right, right sir. 88,363.
Okay. Now, so present value of cash inflows is 88,349.6. Value of cash outflow is 80,000. So that comes to 849.6. So that is the reason I have told you that there are some option is there which I don't know what is wrong here. I don't know what is wrong here. And if you do one thing, because in my opinion, that should be 10,000 and that should be 20,000. Okay. If you do this also, then this will be 40 minus 10 minus 10. That is 20, 8, 12, 10, 22. Okay. So if you do this, 22,000 into 3.433 plus 5190 plus 10380. Let's do this also. So that comes to 75526 plus we have calculated correctly. There are some mistakes. That comes to 11096. Answer B is correct. Answer B is correct. Actually, if you see working capital recovered 100%. So there are typing error in the question. You got my concept?
Yes, sir. Understood. Understood.
There was typing error. In normally, if you have recalled, working capital recover 100%. So this should be 10,000. This should be 20,000. The answer B is correct. Okay. Okay. Let's do some other. What is the question for the additional question? How many units need to be sold if you want to generate 14% return? Okay. Okay. So your investment is how much? 80,000. So 14% return kitna?
11,200.
That will be 11,200. Am I correct?
Yes, sir.
This is your profit after tax is 11,200. So profit before tax will be am I correct?
Correct, sir. Correct.
Okay. Now profit before tax is 18,667. Here, if you recall the concept of marginal costing, so this is the basically contribution required upon contribution per unit. Yes or no? So contribution required will be 18,667 plus 10,000 for the fixed cost plus 10,000 for the depreciation. Upon contribution per unit is 20 rupees. Can you see? My answer comes 1933.
Yes, sir.
So problem is that here 1933 is no option is there. So we can take this one. Okay. Okay.
Yes, yes, sir.
Now in another question, they have reduced the contribution. Yes, Mr. M.S. Keshava, you have raised hand. You have to speak. I can't see you. You have to speak.
Yes, sir. Yes.
Okay, now in third part, it will be 38667 upon 5.
Hello.
Yes.
Can you hear me, sir?
Yes, I can hear you.
Sir, the investment you have taken here as 80,000 rupees, but why you have not considered the residual value what is given? Why is that?
Sir, we have basically the present value of the cash outflow. Initially, you have to invest 80,000 rupees. Huh?
Correct.
So if you deducted the amount that 20,000 and 10,000, so that you will receive after 5th year, and you have calculated, you have already considered the present value of these. I have calculated 80,000 as my investment.
Correct. 14% is the required return what we require on that investment.
Yes,
but in
my investment. Today you have to invest 80,000 or 50,000.
80,000.
Then you will ask return on 14% on your 80,000. Nah? Whatever you will receive after 5th year, that you have already taken as a flow.
But in this question, we have not taken, no, sir. Oh yeah, in the present value, it is getting calculated, is what you are telling us.
But here.
Yes. Okay, got it.
1,000. I am telling you, my outflow is 80,000. So I need return on this 80,000.
Okay.
Whenever you start the project, So you consider the amount which you have to pay now.
Understood. Yeah.
Okay. So now,
Okay.
since selling price is reduced to 15, the contribution per unit will be reduced from 20 to 5. So the number of unit will be 38667 divided by 5. That comes to 7733. So I have already mentioned in my question, the options are given are not correct. Some error in question. So, but I have given you how to calculate the question. Maybe you got the same question, or maybe you got a new question.
We got the same question. We are so lucky enough.
I am telling you, brother, that you will see 1 to 2 questions from today's session. If you are giving the exam in coming 1 month,
Thank
I'm
you.
100% sure. We are the first person in India who has provided the solved case study in the book. Nowhere solution was there, only questions was there.
Please, we are some lucky, sir, to have this.
Because we were facing so much issues in these case studies, and we have solved the case study. Okay, this is the question which I have recently asked. It will take approximately 20-25 minutes. So I think so. People have no issues.
Yes, sir. Please, please, please.
Okay. And if you want, if you say, I will conclude right now, or if you ask, we can do.
We can do, sir. We can.
Okay. So this is a long question, so we have to read. Yes, Mr. Raj B, please tell. Mr. Raj, you have to speak.
Should I read it, sir?
Okay. I'm reading the question. This is a very good question. Okay. And from the Case Study Institute has asked. Mr. Akash, a research analyst, has been hired to Value Home Technology, a company that is currently experiencing rapid growth. The first case study, which we have already told, and expansion in and engage in providing software solution. This. Akash has had extensive experience in value in similar firm. He is convinced that value of OTL can be reliably obtained through the use of relative valuation method. Now, in the earlier method, we have applied discount model. Here we have applied relative valuation. Relative valuation is nothing, but we are taking the valuation of the peer groups, okay, and we calculate valuation of our company. Okay. Now there are 3 companies, Infosys, TCS, and MST. They have calculated the EV upon EBITDA multiple also, EV upon sales multiple also. Now, I am just going in the question part. These are the basically fact figures. Based on mean industry EV upon sales multiple, the enterprise value would be. Mean is how much? Median is how much? Median is 2.0. You can see here. You can see here.
Yes, yes, sir.
Yes, sir.
So, value of firm is median EV upon sales multiply sales. That is 2.0 into sales is about 25 crore. Yes? Yes?
Yes, sir.
You have to speak. Otherwise, there will be only one-way communication.
Yes, sir.
Yes, sir. 50 crore.
Now, third question is, they have asked mean industry. So mean is the average. So mean will be
Simple average.
plus 16 plus 18.
Simple average.
That will be 18. So this is how much? 18.
18.
Enterprise value will be
360.
EV upon EBITDA into EBITDA. Okay. Now I have to calculate the EBITDA first. So how to calculate EBITDA? We have EAT. EAT is 126.
6.
Tax is 30%. So EBT is 126 upon 1 minus 30%. That will be how much? 180. Yes.
180, sir. 180.
Plus interest is 5.
5.
Plus depreciation is
20.
20. So
Total 205.
yes.
Yes, sir. Yes, sir.
So this will be how much? 18 into
205.
0.05 crore. Yes, lakhs. Can you give me the values?
36.90.
39.60. Am I correct?
Yes, sir.
So this answer we have received. Now there are another value. This is debt equity ratio. The weighted average cost of capital we are asked. So the company has beta is this.
Sir, 36.9 are, sir. 18 into 205.
2.05.
Yes, sir. 2.05. It is coming 36.9.
No. 36.9.
Yes, sir.
Okay. Let me check. Yes, 36.9. You are right. So some error is there. This should be 36.9. These error you will face in your exam. Correct answer is this. I'm telling you, I have seen a lot of questions where IBBI has different answer, but the correct answer is 36.90. Okay.
Okay, sir.
Now the weighted average cost of capital. So KD is how much? Is there anything given? KD is how much?
6%, sir.
Where? Yes.
Sir, here, sir. Risk premium.
Okay.
Interest rate.
So, we have KD. KD is 6, 1 minus 30%. That will be 4.2%. Okay. And KE is equal to risk-free return is 7% plus 1.4 into 6%. That comes to 15.40%. Am I correct?
Yes, sir.
Now WACC, we have already given you the formula. KD 4.2 into 0.5 upon 1 plus 0.5 plus 15.40 into 1 upon 1 plus 0.5. That comes to 1.40% plus 10.26%, that is 11.66%. So what I am trying to say, the question is very simple, but you have to know the basic concept and the application of the question. I hope I have tried to bring you from your silos to the clarity mind.
Yes, sir. Very good.
Very much, sir.
Very much.
So I think so. Now we should conclude it.
Okay, sir.
Thank you,
Okay.
sir. Thank you so much, sir.
Okay.
Thank you, sir, for lucid explanation. It is very detailed explanation. All fundamentals you injected in the short time.
Actually, yes, sir.
Thank you, Mr. China.
Thank you so much. So really nice, sir. Actually, if you see within just a span of 2.5 hours, the entire concepts what we have studied for SFM paper we have studied, sir. Actually, and I'll tell you, sir, for these 20 marks in the valuation exam are most difficult, sir, and you have made it very easy.
That's the reason. That's the reason. Because if you go through the PowerPoint presentation,
Yes.
people are not very. I am telling you upfront.
Yes.
People just okay. We will read and we will study. So I have tried to bring all these people to come to the concept.
And many of the cases, what happens is the speaker speaks all the formulas in Excel, sir. Those also are not coming for us. So these are like the fundamentals we have again understood, sir. Very nicely, sir. Thank you so much, sir.
Thank you
So
very
which
much
is
for
a
giving me the
better way
opportunity.
of doing problems on Excel or on calculator in exam?
If in my suggestion you go in the calculator part, but Excel is also there. So in some exam center, Excel they provide, sometimes they not. So better you have practice in both. If you have been provided Excel, your calculation will be very easy.
Excel they are not providing, so they're giving the open source data.
Open Office will be there, sir.
Open Office data, which is more critical than Excel, than calculator.
Sir, in my opinion, I have done question manually in class also and in my exam also. So I have done the question manually. So there are less percentage of error. I would suggest that only you do the question manually. For that, you need a lot of practice.
So finding present value for 5 years, I think it may be a problem. Or
No, not at all. You just put 1 plus percentage on the calculator, plus memory, plus memory, plus memory, plus memory, plus memory, and the memory remove.
Okay.
These are very shortcut.
Will you share this question answer to us?
Yeah, I will share all the things which I have done today.
But is also added to the evaluation group, so you can directly put those things in the evaluation group itself.
And you can give me any questions from anywhere. I will try to provide the solution. I am on the many groups and solution only I am providing.
So one of the question has come up. Sir, one of the questions come up from here only. From one of your questions, they have given this 20 lakhs, this all equity, debentures, and can you hear me, sir?
Yes, I can hear. I'm hearing.
Equity, debenture, and preference shares. They have given the one amount, and then they said 20 lakhs equity is to be raised, and they said use the word optimal capital structure. Now, optimal.
Okay. That question is with me. That question is with
optimal
me.
means what? Current or what is the meaning of optimal?
In that case, you have to understand the current structure is optimal.
Current structure is optimal, or you have to derive what is a good structure?
No. That is a very different verticals. Then you have to apply the capital structure theories there. So you have to apply the concept that the current structure is the optimal. So the ratio of the equity and debts should be similar. So the question is like that. I am telling you the question. I know that the question is there.
20 lakhs, 40 lakhs question is the same way.
No, I am telling you the question. The question was that there are some capital. Suppose 100 crores is the capital. 50% of the net assets to be increased or to be invested. The retained earning is there, and after that they are asking what will be the WACC on the optimal capital structure basis. This type of question is there. I will give you that question on the group and the solution also. Don't worry about that.
So for here, this solution also you're going to provide for this whatever question you are given. That solution is also there.
Sir, I will. I can
Can
share
you provide
you.
some extra?
No, this is the question. I am telling you. This is the solution. Actually, I have just found it that 50 lakh, 10 lakh, and 40 lakh is the difference. Preference share capital, equity share capital, and they are investing to be raised in the form of 95 rupees. So I will give you that. Don't worry.
Okay.
I
So
have
another thing, the question in the they use the word interchangeably: return of capital, market return, the cost of equity.
Sir, these doubts you have to, once you do the practice, once you interact with us, we will resolve all these doubts. That we understand that these doubts are there. Sometimes they are asking return on equity, sometimes they are using different words. I understand that. So you interact on the groups, we will try to resolve all the doubts here.
And so which is the book for the, just last question, what is the valuation books or theory part we can refer to it, where they are available everywhere?
You can ask Mr. Masta.
Yeah, it's your book only. Okay.
No, I'm not advertising my book.
No. But sir, sir, I have not gone to your book. Theory part is also there, sir.
Sir, only theory part is there in a beautiful manner with solved case studies, with 500 questions, important questions, with 5 mock test papers. Complete package at a very reasonable price.
So where it get it? We have to apply online or where? I have not come up.
You can buy from us also.
Okay.
Sir, I can tell you, sir, openly, there is a 2 volumes, sir. One is the theories, sir.
No, that was the earlier book, which we have basically replaced. There was some copyright issue.
Yes, I know, sir.
So we have replaced from one book. Now theory book is there. We have also authored one practical book.
Yes.
But the volume is there. But the content was very used in the practical books. So we are now revising that practical because we have introduced the merger and acquisition and international financial, lot of things we have introduced. But recently they are not asking, but they are slowly increasing the syllabus and scope of the valuation part. So we will that will come in future, I know, but presently it is not required. So our revised edition will be available in 10 to 12 days. We are working on that. That will be lower as compared to the earlier version.
As presently, it's mostly available in the Amazon, sir.
So I have authored the insolvency book also. I have spent approximately 1 year. And the thing is that we have specifically mentioned the amendment below the section, which is nowhere available in anywhere, neither in Act, neither in any book. Because once you go through the books, you will know what was the earlier amendment. Now,
Yes,
and my humble submission is to all of you, please pass the insolvency exams if you have not passed, because from 1st January 2021, that will be a very, very tough. The reason is that they have reduced the percentage of insolvency IVC from 40% to 25%. And approximately 40 to 45 marks, they have introduced the case studies part, where they will asking the individual case studies, the liquidation case studies, and the case laws part. So from 1st January 2021, it will be more difficult. If I say in 2017, people passed by just reading the Act and regulations. Now they have to read approximately 15 to 20 days. After 1st January 2021, it will be approximately 1 month or 1.5 months study. So if you have not gone through IV insolvency exams, please pass it as early as possible. Valuation syllabus is not going to change. They will definitely increase the scope, but IP exam syllabus is changing.
Thank you, sir.
Okay. So
Thank
you
you,
for
sir.
presence
Thank
hearing.
you so much, sir.
I've taken approximately 2.5 hours.
Sir, thank
Thank
you.
you, thank you a lot,
It
sir.
was
Thank you a
very
lot, sir.
useful, sir. I can tell you it was very useful. And you explained the concept very well, sir. Let me tell you, sir.
Thank you very much. I always try to provide the basics first. And
I will tell you in the hello.
Yes,
That
yes, yes.
last question I have spent 20 minutes and answer was wrong. What we should do it? IBBA with that working capital thing. I have spent at least 20 to 25 minutes.
3 minutes.
Okay.
We have solved it in 3 minutes only.
Yes, Chairman sir, J.S. Rao, are you available? Yes.
A quick word from Ritesh Mittal sir about the session.
Sir, actually, I'll tell you one thing, sir. This valuation, though we are doing this 50 hours of training,
yes, sir.
But this practical part we are still missing there, sir. This is where the issue is coming. Had this 50 hours of training, we get there properly, the issue is not coming. The issue will not come only. But the problem is
Can I interrupt?
RBOs are not taking it seriously. So that is what I felt.
Can I interrupt?
Yes, sir, please, sir.
I am also taking the 50 hours training for the participants. And I'm just, it is privileged to me. Now approximately 80% of my participants are registered.
Correct. Yes. So we thank you, sir. Thank you so much, sir, BL Chakravarti sir, for actually you have now the confidence has come, sir, that we can take this 20 marks. Earlier we had this issue with 20 marks only, sir, because by CA profession we are good with theory, but when it comes to practical, sir, this is where we are facing the problem, sir, and we have got the confidence and manually now we can do it with calculators. So that's what we feel, sir. So thank you so much, sir. We will be connected and most probably will clear, sir.
Thank you, sir.
Thank you so much, sir.
Thank you, Mr. It is the confidence that after completion of this IBC course, Chinmastan sir and Prasanna sir and Gopal Krishna Raju garu is clearly asking for this course, and because of only the practical aspects that are involved in this course, so that people will get recharged, and a quick word of that review part will be there, and suddenly they can attack the exam just like that. That is the only intention.
My teaching style is same, whether I am taking for insolvency or whether I take for valuation. I take from the inception, from the basic concept. I never take on a PowerPoint presentation. I give PowerPoint presentation, but in PowerPoint presentation also, the people are connected because I ask question on each and every slide. So the people are not allowed to sleep.
Understand, sir. We miss IBC, sir. Now that thanks to Chinmastan, sir, the last moment that we could able to include you in this faculty, this thing, sir. Really an excellent job. A word from Chinmastan, sir, to conclude the things. Chinmastan, sir.
Yes, sir.
Yeah.
It's come to my turn.
Yeah, quick word to close the session.
Yes, sir. So I'm really happy, sir, because yesterday also I joined, but spending the time up to this time, most of the active members still are waiting for any other inputs will coming. So that is the attractiveness of your speech, sir. So really we are happy. I can heartfully say that, sir, I passed that insolvency exam. I read completely your volumes, sir, insolvency, both the books, both the volumes. So only one newspaper reading only. I took the important questions as a short notes. Based on that, I prepared. So then it's a fourth attempt I qualified, sir, really. So that is the confident, that is the fundamentally I got from that book, sir. So that way I am more confident. Before I never saw your lecturers, still I request the branch and all the MC members, this is the speaker, he will give the good inputs. So the MC also, Vijayawada branch has considered and included your name, one of the speaker, and now it's approved that you are the best person, one of the best person. That's really happy, sir. Thank you so much.
Thank you, sir. Thank you very much. And I am really thankful to all of you for giving me this opportunity to connect me to South, because I am concentrated on North only.
Sir, I can give the clarity, sir. With your language, we are very comfortable. There is nothing difference we feel as a North or South, but it's all of the, it looks like a South language. There is no difference.
Thank you very much.
Actually, we won't you,
Thank
sir.
you.
We won't you. There is no doubt about that.
Yes.
Thank you, sir. Thank you very much for your wonderful way of explaining the things. And many members, many delegates are really thrilled and anticipated the same. And thank you very much. And with this, I conclude this session and taking off, signing off today. And tomorrow by exactly 5 o'clock, we'll be starting again. Just we are starting this webinar model just like that. We are putting the same link for the tomorrow.